probably in the sort of global relief rally.
Markets are pricing in a resolution.
Equity markets have started living in the future.
This type of environment, you just stay in large caps.
There's a short-term look-through in the market. That's what keeps the stock market going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday following a week full of verbal intervention.
Iran is in very bad shape. I think they're very desperate.
They want to work a deal. They would like to work a deal.
They're willing to do things today that they weren't willing to do 2 months ago. No nuclear weapons. Free oil, free Hormuz Strait, everything would be nice.
The president claiming Iran is making key concessions, happy to send equity markets to back-to-back record highs, even as some foreign leaders are indicating a peace deal could take 6 months to be fully agreed.
Yeah, here's the issue. We've seen a complete reversal, a violent reversal in equity markets with one of the fastest rebounds ever from some of the lows. And yet, yes, there are some caveats, like it is going to be difficult to discuss the nuclear dust as well as reopening the Strait of Hormuz in any kind of feasible long-term way. It doesn't seem to matter because ultimately people see that there is a desire to prolong this ceasefire. At this point, talks between the U.S. and Iran are focused on simply extending the ceasefire out to those 6 months to get some sort of longer-lasting agreement.
Back-to-back record highs in the equity market, heading towards 3 weeks of gains on the S&P 500 for the first time so far this year, encouraged by the words of the president. The claim, a key claim, claiming that Iran is making key concessions. We've yet to see that come from Iran, and that is a key sticking point.
We've yet to see that come from Iran. Reuters has some reporting that actually Iranian officials told them that maybe it won't be a full-on deal that you can expect before the ceasefire ends or within the next few weeks if a ceasefire is extended, but something more of a memorandum of an understanding to then get to longer-term peace. The president, though, is saying they're making key concessions. I mean, he told me weeks ago on the phone that they're ready to settle. At the moment, there is no deal, but the bombs have stopped. The key issue for this administration, as well as France and the UK, which are hosting this conference, is reopening the Strait of Hormuz.
Let's work through the stock moves that we've seen over the last 1-2 weeks. The move on the Nasdaq, 12 days of gains on the Nasdaq 100. Looking at energy stocks, down 8% through April. Consumer discretionary up around 10% through April. That's the big turnaround there. But within tech, we've seen semis absolutely rip. This week, Microsoft is on course for its biggest weekly gain in more than a decade. And the must follow ETF software index that a lot of people were shaken up by several months back. I tell you what, the week that's had, that week for this particular index, that index has been on fire.
Yeah, and some of the last time that we've seen moves like this is going back to the dot-com bubble, which is one reason why people are getting a little concerned, because what you're seeing is winners and losers, and on the whole, you're getting huge dispersion within the tech trade. At the same time, yes, you are getting a number that are completely ripping. Nonetheless, there are winners and losers, and you can see this shaking out with software. The likes of software really kind of struggling in certain pockets, even as others get that rebound. So when you take a look at this, is this a healthy rebound, or does this indicate some sort of blow-off top where there's a lot of concentration risk in a couple of key names?
Equity futures on the S&P so far this morning, positive by 0.25%. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research, with stocks on course for a third straight week of gains. We'll speak to Gregory Allen of CSIS on why Anthropic's new AI model is a watershed moment. And we'll speak to the Egyptian Trade Minister, Mohammed Fareed Saleh, on the economic impact of the war on the Middle East. We begin this hour with stocks holding steady after reaching fresh record highs. Ed Yardeni of Yardeni Research writing equity investors certainly have reason for optimism. Ed joins us now for more. Ed, welcome to the programme. Let's get to those reasons. What are they?
Well, first and foremost, as the Middle East situation has calmed down, the war isn't over. There's a ceasefire. It may or may not take 6 months to get a full peace agreement. But the main point, as you said, is the bombs aren't dropping and things are calming down. Then, of course, secondly, earnings have been on fire. We've had earnings-led melt up in the stock market for a while, actually. And as the war occurred, the earnings expectations continued to increase at a faster pace. So the analysts didn't get the war memo, and they didn't get any feedback from the companies they follow that this is a concern for earnings anytime soon.
Ed, we're getting some feedback from the equity markets, some clear feedback. The enthusiasm for tech again is overwhelming. The 12-day run on the NASDAQ 100. Within tech, it's not just chips. We're seeing the likes of Microsoft, which at one point was really, really struggling, have a fantastic week as well. Ed, what's behind that renewed enthusiasm for that tech trade?
Well, in two words, or three words, the roaring 2020s. There's a lot of similarities between the current decade and the 1920s. The big one is technologically led productivity gains, which increases the purchasing power of consumers. We're seeing that. It increases the growth rate of the economy. I think we saw that most of last year. I think we had some weakness in the fourth and first quarters, and I blame that on the weather. So I expect to see, remember Chauncey Gardner from being there? I expect in the spring there will be growth. I think we're going to see tremendous growth. And really, the economy's resilience has been phenomenal, and therefore earnings have been phenomenal.
Does this type of performance in markets give you comfort or give you pause, given the incredible volatility, the whipsaw, the biggest shift from oversold to overbought, 18-day kind of round trip going back to 2016? I mean, doesn't it scream of something unstable rather than a sense of calm strength?
I'm pretty calm about it all. I'm comfortable with the way the market's behaving because what it does is it kind of tests out the idea that there's trouble ahead. And so we saw that with artificial intelligence. We had a few corrections in that area, but yet, for all the talk about an AI bubble bursting, that's just not occurring. More money is being spent not just by the hyperscalers, but by people like me who are signing up for Claude and ChatGPT. I mean, I'm using all the models. Some of them do some things better than others. But I find myself using artificial intelligence all day as a research assistant. Now we're creating some AI tools to help us do our job. So it's increased our productivity. So from my perspective, it's all good.
You're going to make me sound like a Debbie Downer, but the more you say it's all good, the more I'm going to try to poke holes in it. And at this point, the other hole that people are trying to poke is, can you have two things at the same time? The idea that earnings are coming in better than expected, an economy that's more robust than expected, and commodity prices that are higher than expected without some sort of commensurate inflation that could potentially curtail some of this enthusiasm?
Well, I think everybody's expecting that inflation will be picking up here in the next few months. But when we had that inflation burst surge, I should say, in 2021, 2022, a lot of that was first led by supply chain disruptions, which put a lot of upward pressure, particularly on durable goods prices. Then Russia invaded Ukraine, and so we got, on top of that, we've got a spike in oil prices. This time around, we're seeing that the impact of last year's tariffs is probably wearing off. We're seeing that home ownership inflation is the shelter inflation component of consumer price inflation is coming down sharply. The price of oil looks like it's doing another one of these short-term spikes, reminiscent of 2022, without the pass-through that we saw in 2022.
Ed, when it comes to the stock market, how much are you feeling calm, and how much are the recent gains because of verbal intervention from the White House?
Well, obviously that had a big impact. A lot of the concerns that people had that caused the market to go down by 9% from from January 27th down to March 30th. Those concerns have been around for a few weeks. People kind of kick the tires and realize that there's no flat there. The tires are still inflated and cars still moving forward. And I think that's a reasonable analogy for what we're seeing here in the market is the AI concerns created buying opportunities. And by the way, everybody knows now that geopolitical crises create buying opportunities. So we've got this annoying situation where you don't get a chance to buy for very long. You really have to jump in and just buy on the dip. Otherwise, everybody's buying once they figure, let's look through this geopolitical crisis, and we're getting some really good bargains here. And one of the reasons we're having good bargains is PEs came down not just because valuations crashed, but because earnings really took off. So usually you buy high PEs expecting down the road you'll get better earnings, but we've had almost instant gratification with earnings continuing to significantly surprise to the upside. And it's not just technology and it's not just energy.
Ed, we appreciate your enthusiasm, sir, as always. Ed Yardeni there of Yardeni Research, constructive on this equity market. How many times have we heard this, that the adverse scenario is so adverse that we won't see it because ultimately they'll look to avoid it? When you listen to the president claiming the Iranians have made key concessions, we don't know if they have. We've yet to see evidence of it. When you listen to the IMF and the World Bank through this week in Washington, D.C., they've been pretty clear. Every day that goes by that a Strait of Hormuz remains closed, you get closer and closer to that so-called adverse scenario.
Yeah, and part of the reason why the IMF is particularly concerned is because every day another country comes to them with their hand out asking for money to try to stave the gap that they have in their budget as a result of trying to buy energy and the fact that their economy is slowing otherwise. So they're feeling it on the ground in the most vulnerable countries. On a whole, this is where the averages mask individual pockets of pain, and the reason why you can get a very different sentiment than the overall averages that speak to a much more resilient kind of economy.
And when it comes to individual pockets of pain, Bank of America Institute has a note out this morning talking about small firms, especially transportation, agricultural. Their spending on energy, gas, diesel, up 25%. And this is now April. This is ahead of key driving season when prices naturally, most normally, go a lot higher.
Heading towards another week of gains on the S&P 500. Despite all of that, futures up by 0.25% with an update on stories worldwide. With your Bloomberg brief, I'm pleased to say that joining us now is Scarlett Fu. Hey, Scarlett.
Hey, good morning, John. President Donald Trump says the war in the Middle East could end soon. Trump says it may not be necessary to renew a 2-week ceasefire with Iran before it ends early next week because the war could be over before then. He also said the U.S. and Iran could meet for a second round of negotiations this weekend. Meantime, President Trump also says Israel and Lebanon agreed to a 10-day ceasefire. Trump says he held, quote, excellent conversations with leaders of both countries. There was no immediate confirmation from Israel or Hezbollah. And the U.S. government wants to make a version of Anthropic's AI model Mythos available to major federal agencies. A memo seen by Bloomberg did not specify when various agencies would get access or how they might use it. That is your Bloomberg brief. John?
Hey, Scarlett, thank you. Great work, as always. Looking forward to catching up with Scarlett again later this hour. Some reporting from Axios coming about 15 minutes ago, that the boss of Anthropic will be meeting with the chief of staff of the White House, Susie Wiles, a little bit later on today. There's a bit of a contradiction, some tension here that's worth exploring. That on the one hand, this company is a so-called supply chain risk. On the other hand, they want to use this company within the government across various departments.
And the extra tension is that they already are using this company across a variety of different departments. And you could argue they've been instrumental in the entire effort in Iran, as well as in other conflicts that the U.S. has been involved in. It is a difficult moment. Which side is going to give? And how do you understand this uncomfortable situation where executives have a good degree of power over domestic security and international security of different nations?
We'll catch up with Gregory Allen of CSIS a little bit later this hour on that topic. Up next on the program, closing in on a deal with Iran.
I think we have a very successful negotiation going on right now, and I think it'll be, if it happens, it'll be announced fairly soon, and that'll give us free oil, free Hormuz Strait. Everything will be nice.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations, live from Washington, D.C. this morning. Good morning. Live from Washington, D.C. this morning. Good morning to you all. Equity futures right now in the S&P 500 firmer by 0.25% following a 4-day winning streak on the S&P and a second consecutive day of closing above 7K. On the S&P so far this morning, up 0.25%. On the Nasdaq, up by 0.2. Under surveillance this morning, closing in on a deal with Iran.
I think we have a very successful negotiation going on right now, and I think it'll be, if it happens, it'll be announced fairly soon. And that'll give us free oil, free Hormuz Strait. Everything will be nice. And I think your oil price will go down to lower than what it was before. And I think a lot of good things will happen. If there's no deal, fight and resume.
So here's the latest this morning. President Donald Trump saying Iran has made key concessions ahead of potential negotiations later this weekend. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John. Good morning. Well, President Trump says that he may not even need to extend the ceasefire set to expire on Tuesday, telling reporters that progress has been made related to Iran's nuclear program. He says that the country is prepared to turn over its already highly enriched material in what would be considered a major breakthrough for the negotiations. But at this point, Iran has not weighed in on these latest remarks, and at least publicly, recent comments do indicate that the sides still appear very far apart, which is part of why Bloomberg News had been reporting that they were mulling a potential 2-week extension to give time for technical teams to make a little bit more progress. And now some Gulf, Arab, and European leaders are telling Bloomberg News they don't see a U.S.-Iran deal materializing for another 6 months. Importantly, this reporting also goes on to indicate that Gulf allies share U.S. concerns that any deal needs to include a permanent ban on Iran's nuclear program. Of course, though, it's not just the nuclear program. We are also learning some more details about how the Strait of Hormuz has been operating, as the Pentagon confirmed yesterday that it has expanded its blockade from just Iranian ports to also include any vessels in the so-called shadow fleet. John, as we await more details, as you well know, the UK and France are holding the summit today with more than 40 nations about deploying a potential naval force known as the Maritime Freedom of Navigation Initiative. The overall sense is that these assets are not going to be deployed until there is that longer-term agreement.
We'll be tracking those negotiations if they happen through the weekend. Tyler Kendall there with the latest right here in Washington, D.C. To build on that conversation, Stephen Cook of the Council on Foreign Relations writing the Iranians will demand a role in whatever is planned and will not give up whatever leverage they have. Stephen joins us now for more. Stephen, good morning. Good to see you.
Good morning. Good to see you.
Let's talk about some of the claims coming from the president, claiming they've made some concessions. Can you just outline your understanding of what the demands are and what the concessions might be?
Well, the demands have been pretty consistent, that the Iranians have to give up their nuclear program, they have to give up their missile program, and stop arming and supporting their proxies. I don't see any real movement on the part of the Iranians. There may be a negotiation. The Iranians may demonstrate some tactical flexibility in order to get themselves out from under the problem that they've now found themselves with, an economy that's teetering on the edge. But they want to live to fight another day. And the people in charge in Iran right now are the hardest of the hard line. I mean, the president keeps talking about this new pragmatic regime. These are people with a history of waging war against the United States and its partners for the last 47 years.
Is the president just basically insinuating they're pragmatic because they showed up to talks? Is that it? Is that the only step we've seen from Iran to be willing to negotiate with the United States, is that they actually showed up in Islamabad?
Yeah, that's precisely it. I mean, they're willing to talk. So essentially the president is Roy Cohening this. He's saying something that he wants everybody to believe, and he's trying to create his own reality on this. But there's no indication that this group of people are willing to meet the United States. They're not willing to capitulate on the battlefield. What makes anybody believe they're going to capitulate at a negotiating table?
You're right to say this administration has been very consistent with what they wanted to see from Iran. But now there's this extra additional need, which is the opening of the Strait of Hormuz. Would the United States or Gulf partners accept the Strait of Hormuz be open, but Iran would get some sort of monetary fund for that, a toll?
It strikes me that the United States will accept that at some point. The Gulf states will be very, very unhappy about this. I mean, think about the strategic setback this is for both the United States and our Gulf partners. Before this war was launched, there was freedom of navigation through the Strait of Hormuz. Now the Iranians have some notional leverage over the strait, although we're blockading it right now. Some resolution of this that gives the Iranians a role is something that no one ever imagined. And can you imagine a situation in which the Emiratis or the Saudis have to pay their primary regional adversary for transit through the Strait of Hormuz to keep their economies going? This is a tremendous strategic setback for the United States, as well as the Emiratis, the Saudis, the Iraqis, the Bahrainis, everybody in the region.
And it's not just about Iran, it's also about China. And the Atlantic Council put out a graph showing that the number of cross-border payments transacted in renminbi has gone up tremendously in the past 6 weeks. I mean, how much do you see China stepping in? and trying to create the petro-yuan to try to reassert themselves in terms of the voice of influence over the region?
Yeah, I think the Chinese stand to gain here at the expense of the United States. But I think that the Chinese also have a compelling interest in freedom of navigation throughout the world, but particularly in the Strait of Hormuz. They also have a ton of oil in storage. So I think the Chinese are well placed to play a role. They have pushed the Iranians into talks and made their preferences known. But I don't think the Chinese are really wanting to step in and replace the United States here. After all, to the extent that the United States gets wrapped around the Strait of Hormuz, Iran, and the region, there's less time for the United States and less resources for the United States to focus on East Asia.
It is not completely clear what all of the goals are. There is a general goal, though, in the United States and in the Western world, freedom of navigation through the seas, a desire not to see a nuclear Iran. What's Iran's ultimate goal, given the new leadership?
The ultimate goal of this regime is survival.
Okay, but beyond that, but beyond
is
that,
to continue its nuclear program. I mean, the ultimate guarantee of regime survival, to hold on to the leverage that it now has in the Strait of Hormuz, which is something new, which is almost as good as, if not better, than a nuclear program, because you might be able to make money off of it, and to continue to play a role and put pressure on the rest of the region. The Iranians have not given up, despite the battering that they've taken, any of the basics of their approach to the region and their approach to the United States.
There has been a change of strategy from the United States. There is now a blockade of the blockade. Does that mean Iran has lost leverage, or are they just going to wait this out?
The Iranians look at the world in a very different way than the way we look at the world. We look at the world in 2, 4, 6, 8-year periods, because that's our electoral cycle. Those in charge of the Islamic Republic have a much longer time frame. So they'll wait us out. They'll wait out. A new administration will come in. They'll have some new approach. And even if there is some change, there's a blockade of a blockade, but there's some negotiation that's going to go on about the status of about the Strait of Hormuz. They're going to insist that they play some role in it.
But right now, they can't move their product either. And at some point in the next few weeks, analysts say there's going to be shut-ins. They could do some serious damage of their wells, which is oil is basically the main driver of their economy. Do you think that could force them to be a little bit more pragmatic?
Well, certainly the economy is on the verge of collapse. The Israelis and the United States have done tremendous damage from the air, and now this blockade is making things even worse. But keep in mind, as I said before, this is the hardest of the hard line. They'd rather eat dust than capitulate to the United States. So I think this is going to go on much longer. And again, at the negotiating table, there might be some tactical flexibility. They're interested in sanctions relief, but are they interested in solving all the issues between the United States and Iran? I don't think so.
Really tough question to answer, but I've got to ask it, and forgive me. You've got a base case of how long the Strait's going to be closed for?
I think the Straits are going to be closed for at least the next few months.
The next few months?
I think it's entirely possible that, it's going to take time to negotiate the end of this blockade, that the Europeans are talking about this mechanism. It'll take time for them to get it together, to get naval escorts through the Strait of Hormuz. That's even assuming that the Europeans have the kind of organizational capacity to actually do this kind of thing without the help of the United States. And as I said, I think we're talking about the hardest of the hardliners. There's going to be tactical maneuvering around negotiations, but it could be a while before the Strait is actually opened in a way that the economy can get going again.
Stephen, appreciate your perspective. Thank you, sir. Stephen Cook there of the Council on Foreign Relations. If there are any Europeans in Washington waking up this morning at the IMF World Bank spring meetings, hearing the next few months, I'm sure they'll be immensely concerned. We've seen the rationing take place in Asia. And if the Strait is closed for another few months, you'd imagine you're going to see similar things take place in European nations in the weeks to come.
What did we hear from the IEA yesterday? Fatih Birol talking about that Europe is 6 months away from running out of jet fuel, and we're seeing flight cancellations from European airlines because they don't have access to the product.
Unreal. Yeah, equities are at all-time highs on the S&P 500 and on the Nasdaq at the close on Thursday coming into Friday. Futures up another 0.25% so far this morning. Up next, we've got to talk about this. Gregory Allen of CSIS, as Anthropic's latest AI model has markets and the government very much on edge. That conversation just around the corner. Live from Washington, D.C. this morning. You're watching Bloomberg TV. Live from Washington, D.C. this morning at the IMF World Bank Spring meetings through this week. Equity futures shaping up as follows. On the equity market, on the S&P 500, positive once again, adding some weight to a record-breaking rally. 4-day winning streak on the S&P, up 0.2%. 12-day winning streak on the Nasdaq 100, the longest since July 2017, up another 0.1% so far this morning. On the S&P, looking for a third consecutive week of gains. Haven't seen that all year. For oil, down for 2 straight weeks now. We haven't seen that since the war started. WTI crude and Brent shaping up as follows. Brent down by a little more than 3% so far in the session. The front month of the futures curve on WTI, we're down by almost 4% at 91. That's the oil setup. Turn to the bond market. You haven't seen as big a move. We talked a lot about this. Equities have rallied more than 10% of the lows. For crude, we've had a sell-off of about 20% from the highs. But in the bond market, we've settled around 430. Another close above that level just yesterday, Bramo. This morning, we're down by 2 basis points, 429.35. There is a takeaway from some in fixed income that just maybe we've settled at a more elevated level because of this war.
Yeah, and ultimately, if you have strength in the economy that can prop up equities to record highs, and frankly, you've got consumers that can absorb the higher costs coming from commodities, well, doesn't that indicate that inflationary pressures are going to remain just a bit higher than they would otherwise be? Right now, if you take a look at Fed funds futures, there are no rate cuts being fully priced into the market by the end of this year.
Which is going to keep this Fed on the sidelines, to the point. That's what the market is priced for now. Even with the new head of the Federal Reserve and a hearing set to take place next week with Kevin Warsh on deck, there is a belief on this market that those rate cuts won't be happening anytime soon.
Even if Kevin Warsh becomes the next Fed chair, I should say when. Everyone believes in Washington. We've had a lot of conversations about this, that he will be the Fed chair. It's just a matter of timing and scheduling, depending on when the DOJ potentially drops this probe. And then Tom Tillis, the senator of North Carolina, can finally give a yay vote to that. Of course, the issue is, and Lisa brought this up the other day, actually, this White House kind of gave cover to the incoming Fed chair, saying maybe now, right now, is not the time to move around when it comes to rates.
Gave cover to the Federal Reserve. I'm not sure about the incoming Fed chair because at the moment, there's no open door for him to walk through.
True.
I've asked that question repeatedly through this week. Everyone I've met in Washington, I've asked the following question. Why won't the president take the off-ramp? He's chosen his man. He's highly confirmable. The Senate wants to get him through, get him a seat on the FOMC. The DOJ investigation could have gone away, and yet they're sticking with it.
You know, I can't answer that question. In fact, I've tried to read several psychology manuals, and frankly, I think it's above my pay grade.
He's doubling down. He really does not like what has happened. I mean, when the president talks about this, he's emphatic. He does not like what happened at the Federal Reserve. He thinks it's gross misconduct in terms of all the money they spent. I mean, he went there with a hard hat to look at this, and he's doubling down, and he's not willing to take the off-ramp yet. Maybe it changes.
That hearing's set to take place next Tuesday. On our radar this morning, Netflix shares tumbling in pre-market following a weaker than expected outlook. The company's co-founder and chairman, Reed Hastings, separately announcing he will step down from the board in June. Elsewhere, the president claiming Iran has made key concessions in negotiations and a deal to end the war could be announced soon. The president saying the two sides may meet for a second round of negotiations this weekend. And finally, a 10-day ceasefire between Israel and Lebanon is now in effect. The Trump administration ramping up pressure on the two nations after the continuing violence threatened to upend the U.S. truce with Iran.
Look, this is a key part, at least on the part of Iran, to any kind of sustained ceasefire. And the good news is that it is holding for now, that it does appear that the fighting, the bombing has ceased. A question here of Hezbollah, the group within Lebanon, whether they are going to abide by this, whether they have been a part of this. And then Stephen Cook has actually written about this, and I think it's a really interesting point. This idea that if Hezbollah gets sort of downgraded as a party within Lebanon, does that allow Lebanon to normalize relations with Israel, which would be absolutely a setback for Iran? They don't want that to happen. So there are some sort of entrenched sticking points that are going to be very difficult to get over.
There's no way this Iranian regime is going to want to withhold any money and make sure that they want to make sure they continue to support and back all the proxies, including Hezbollah. And in Trump's Truth Social yesterday, he's talking about Israel and Lebanon. No mention of Hezbollah, which is where Israel is fighting. But it could give a little bit more breathing room for both sides of the negotiations to actually have these talks. Because the Iranians, every single time you speak to them and hear from them in their press, they say, well, one of our conditions now is that Israel needs to stop when it comes to the fighting at Hezbollah.
The Strait of Hormuz is still closed.
Yeah.
And every day
oil's
that
at
goes
91.
by, the IMF has said every day that goes by, we get closer and closer to the so-called adverse scenario. I heard from Steve Orth of Federated just yesterday, who's made the point repeatedly that this is so bad that if it can't happen, it won't. That's their view on things. And I think that's the market's view as well. It's so bad that it can't happen, so we can look through it. Yet you speak to Stephen Cook, Lisa mentioned him, we caught up with him just moments ago. He's making the point that this could go on for 2 months. So you've got the analysts looking at the prospect of this going on for 1 to 2 months from here. Maybe longer, who knows? I hope this is wrapped up quickly. But this market is priced for something very, very different.
Well, what's so interesting, though, is that before this conflict began, and with all these reporting that Trump is potentially going to do this, everyone said, well, Iran would never go for the nuclear option, which is actually closing the Strait of Hormuz. That would never happen. It is too dangerous. It is too much of an economic blowback for everyone, not just the global economy, but also the Iranians themselves. And guess what? They did. They went for that nuclear option, and they decided to close the strait.
WTI this morning at about 91, Brent crude in the mid-90s. We need to talk about this story, too. It's one of the big stories here in Washington, D.C., and for that matter on Wall Street. Anthropic's latest AI model sending shockwaves across Wall Street. The White House moving to give U.S. agencies access, even as officials warn of major cybersecurity risks. Gregory Allen of CSIS writing, Mythos is a genuine watershed in cyber offense. Wall Street's reaction confirms this isn't hype. Gregory joins us now for more. Gregory, good morning.
Great to be with you.
Let's start with what this is. Can you briefly describe what is Mythos?
So everyone who has used an AI chatbot such as ChatGPT or Claude is familiar with that kind of interface. And over the past year, we've seen dramatic progress in these capabilities, not just in chatting with users, but actually writing software programs and, as they get more agentic, building fully fleshed out systems. So if you're really, really good at writing computer code, it's not that far away to be really, really good at hacking computer code. And what we've seen is an explosion, a qualitative shift in just how much these models can achieve. This is the latest and greatest Anthropic model, and it is capable of executing, not just finding a bug, but exploiting that bug, going through all the links of the cyber kill chain to successfully execute attack, and doing so autonomously. Now, why does that matter? Because even though we're talking about computers, cybersecurity has actually been under a massive labor shortage for the past 20 years. If you think about, why aren't we able to patch all of these bugs? It's because hackers are really expensive. These are talented folks who are difficult to train. But now, if AI can do so much of that job by itself, you start thinking about Anthropic as a company having capabilities comparable to that of the National Security Agency in the United States government. And fortunately, Anthropic was the one to get to this future first. They're approaching the United States government. They're approaching critical infrastructure companies. They're approaching the key cloud providers and banks and saying, this is what we've discovered. You live in a different world now. Let's figure out how to secure it.
From your standpoint, are you fearful that this could expose vulnerabilities or hopeful it would improve resilience?
So I think there's a sequencing part of all of this story. This is a capability that is useful for cyber offense, and that means doing bad things, but also doing things that are critical to U.S. national security. But it's also a boon for cyber defense, because you can imagine every new piece of software before it enters the world is going to have to go through the Mythos test, which is to say, can you survive this gauntlet? And the reality is, going through that gauntlet before was, number one, pretty expensive and time-consuming, and number two, not perfect. There was a lot of bugs that weren't discovered, and we know that because Mythos just discovered a giant pile of new bugs and all this stuff. So this does offer a world in which we can secure our software more in a bigger way. The problem is that transition point. There is a massive amount of code, whether that's open source code, and it turns out that much of the infrastructure of the internet relies on stuff that is maintained by volunteers, and also big critical infrastructure providers. We're talking banks, energy companies, and the amount of overhauling that they have to do over the next 12 months is massive. And the question is, how long can we keep the Mythos capability exclusively in the hands of the good guys? How much can we patch before problems start arising?
How far behind is the government from the private sector, and how willing is the government to work with said private sector that there's been some tension between?
So if you're talking about, could the United States federal government create something like Mythos? Could they create something like a frontier AI model? They are very, very, very far behind. They're really not even trying. So the only way that they can get access to these capabilities is to work with private industry, the types of folks who can do this. And in this case, Anthropic has what they estimate to be a 6 to 18 month lead, even over OpenAI, even over all the other best AI labs in the world, which are in the private sector. So that period of time is a critical window to start patching all of this computer code before China catches up, before hacker communities get access to comparable capabilities. And tragically, that window of time is one that the U.S. government is at risk of squandering because of a dispute over contracting terms in Anthropic's working with the Pentagon. Just for folks who aren't aware, Anthropic is a critical provider not just of cyber AI capabilities, but also of AI capabilities that are useful in intelligence and warfighting, literally being used in Iran right now every single day. And despite Anthropic providing all those critical capabilities to key national security agencies, over this contracting dispute, the Pentagon decided to label them a supply chain risk. The type of designation that we use when we find out a company is secretly like a front for Chinese spies. It's completely unreasonable. And the government is in this moment of utter confusion, because on the one hand, they're saying, Anthropic, you've got to help us secure the financial arteries of our economy on cyber. On the other hand, we don't trust you at all, and actually we'd prefer if you go out of business.
When we talk to different executives and we ask them about Mythos, they say, well, there's as much good as there is bad, and we're actually really optimistic. When you talk to them, not on a camera, what's the level of concern right now among executives as well as government officials about what this could do in terms of systemic disruption?
So I think the way to think about it is, what if Anthropic wasn't going down this path? Right? Anthropic is suffering in business terms because they're not offering Mythos to all of their customers right now. They've made a strategic decision to withhold these capabilities, to invite in 40 key companies, to invite in banks and government agencies to try and secure the internet from this degree of cyber power. In the alternative scenario, where this fell into the hands of somebody who wanted to use it to make bets on the market, or somebody who wanted to use it to exploit cyber offense in a national security sense, maybe one of our adversaries, we would be having a completely different conversation. So the executives are probably right. Because Anthropic has chosen this strategy of engagement and support, the long-term outlook is pretty good. What they're really going to be dealing with is an incredibly messy middle.
Gregory, you said that Anthropic is being used right now when it comes to the war. How has Project Maven changed how the U.S. fights war?
So Project Maven started out as a relatively humble project to incorporate AI into analyzing drone surveillance feeds. So if you're familiar with those Predator eyes in the sky type of drones, it turns out that here, too, there's a major labor shortage. It turns out that the U.S. military has a really hard time getting people to watch all of those screens simultaneously. So Project Maven thought we can bring in AI computer vision. They can help these analysts by doing sort of the first processing pass of this type of footage. And that was back in 2018, 2019. What it could do is it could say, hey, in all of these satellite photos or drone photos, this part is all empty water, but right here there's a warship. Fast forward to today, and the capabilities are much more sophisticated, in part because we're incorporating things like Anthropic models, large language models. And what that means is that the AI can no longer just say, here is a warship. It can say, hey, there was no warships in this area yesterday. Now there's 10. They appear to be headed in this direction, and it can write the first draft of the intelligence report about what those things might be up to. And it can speed up all of these workflows. When you hear about the fact that, for example, the United States military struck 1,000 targets in 24 hours in the first part of the Iranian war, you know, the benchmark in the U.S. government used to be like 50 per day. And the key thing is not just how many things you can strike, but the fact that many of those targets are mobile, many of those targets are disguised. So when you hear about 1,000 struck targets in Iran, what that actually means is 10,000, 20,000 high-quality intelligence processing and targeting decisions that had to be made. There's no way the U.S. government could have done that without the help of AI.
Gregory, appreciate your time. Thanks for making time for us today. Thank you. Gregory Allen there of CSIS on the latest from Anthropic. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get over to Scarlett Fu. Hey, Scarlett.
Hi, John. At least 2 more empty tankers linked to Iran have sailed into the Persian Gulf. This comes hours after U.S. Naval Forces Central Command warned it would consider boarding and seizing any sanctioned vessels regardless of location. SpaceX is moving up its vesting schedule for employees. Sources telling us here at Bloomberg it could come as early as next week as the company prepares for its IPO, which is targeting a valuation of more than $2 trillion. President Donald Trump warns that New York City Mayor Zohran Mamdani is destroying the city. Trump says Mamdani's plans to raise taxes on the wealthy will cause harm and chase people out of the nation's largest city. That's your Bloomberg Brief. John?
Hey, Scarlett, thank you. More from Scarlett in the next hour. Up next on the programme, bracing for energy volatility.
The situation will gradually improve, but we should be prepared to rather volatile energy markets for some time to come.
Up next, we'll catch up with the Egyptian Minister of Investment and Trade. Live from Washington, D.C. this morning. Good morning to you all. Wrapping up our coverage of the IMF World Bank spring meetings with equity futures adding to gains on the S&P 500, up another 0.2%. This headline just crossing from the EU, planning to prepare a joint action on jet fuel if the blockade of the Strait of Hormuz persists. And it looks like for now, at least as far as we know, it's persisting.
I would love to know what the Europeans think persisting, what that timeline is, because the IEA yesterday is saying 6 weeks. That's all they have left when it comes to jet fuel. And basically, they're going to be closing down some flights very soon.
Under surveillance this morning, bracing for energy volatility.
The situation will gradually improve, but it can take up to 2 years to see the big chunk of the production coming back to the before war levels, and some of them may be even longer than 2 years. We should be prepared to rather volatile energy markets for some time to come.
So here's the latest this morning. Optimism rising over an end to the war as major economic risks still remain high for countries across the Middle East. Joining us now, I'm very pleased to say, His Excellency Mohammed Fareed Saleh, the Egyptian Minister of Investment and Trade. Minister, good morning, sir, and welcome to the studio.
Good morning. Thank you.
It's good to see you. Can you walk us through the current state of the economy in Egypt, how resilient things are, the degree of fuel rationing you've had to implement to get through this very difficult period?
As you mentioned, what's happening in the region is indeed affecting, I would say, economies and markets. However, it's all about the response of governments to the current turbulence and how we deal with it from a policy perspective. That's from the one hand, and the consistency of messages and policy as well being undertaken. So in the case of Egypt, we were very, foreseeing that this conflict might be taking some time as opposed to initial expectations that it is going to end very soon. Accordingly, we took a very, quick actions when it comes to rationing, increasing the energy prices across the different products that are being sold in the Egyptian market. And this is coming from a consistent fiscal consolidation policy. So we foresaw that these type of measures and these prices and what's happening in the natural gas prices, in the oil prices, would be having a detrimental impact on our fiscal deficit. And accordingly, we had to ration very quickly and to adjust prices to reflect what is happening in the oil prices from the one hand. On the other hand, our response to the monetary policy regarding how we're dealing with these type of shocks and the absorption capacity of the economy, the flexibility that we have shown through the Central Bank of Egypt, of course, in terms of the effects to be absorbing some of these shocks, as well had a positive, impact in terms of conveying to the market the consistency of our reforms. We had embarked and clearly communicated to the public and to investors a couple of years ago or 2.5 years ago that we are inflation targeting. So inflation targeting implies that you need to be capable of using your other tools, such as interest rates, such as FX rates, to curb inflation in the medium term and to act as an absorption to the shocks that are happening. So energy for us, we're in a much better initial condition. We have regasification, I would say, ports in Egypt, one on the northern side and one on the Red Sea side, and hence we don't have a problem when it comes to availability. However, the costing, of course, had increased.
When it comes to the Red Sea, though, do you have contingency plans if, say, Bab el-Mandeb Strait gets closed by the Houthis?
It had happened before, so basically we deal with it as it happens. Of course, we work on eliminating or reducing the probability of this happening through political dialogue, diplomatic dialogues, and so on and so forth as much as we can. However, we have dealt with this before, and we get to see what is happening currently in terms of the shipments that are passing through the Suez Canal actually had been increasing and recovering gradually from previous halts in the Strait of Bab el-Mandeb. So, yeah.
Lots of reports that it's not just Pakistan, it's Turkey and Egypt behind the scenes helping mediate between the United States and Iran. What has been your role exactly?
Well, as a Minister of Investment, I don't think I have a role here, but maybe the Minister of Foreign Affairs would be having I believe we have quite a good role when it comes to mediating between the different parties, trying to reach to a common ground regarding the ceasefire, regarding what are the next steps as well. So it's not only about the ceasefire, but the next steps after reaching to a point of conclusion so that we ensure it doesn't happen again. So I'm quite sure that the country itself and as well through the Ministry of Foreign Affairs are doing quite a good communication, I would say, efforts and mediation efforts between the different parties associated. And probably it's not only Egypt as well, you will find Turkey as well part of the equation of these mediation efforts.
While you're here in Washington, D.C., how much are you looking to raise money in case the Strait of Hormuz is closed for, say, months, like an analyst who was just on seemed to suggest?
Our aim today is basically, one, of course, to be attending the relevant meetings and functions at the IMF World Bank. And the second target would be meeting investors, because this period is a convening period for all investors around the world to be participating in some of those meetings. So our target would be explaining to investors what have we done in terms of policy reforms, our consistency in the reform plan, irrespective of what's happening. We cannot be, how can I say, affected by interim problems that are going to happen when we get to see what's happening in the world, starting from emerging market crisis in 2019, COVID afterwards, Russia-Ukraine war, and so on and so forth. So basically, we know that it is a current turbulent period whereby we need to be consistent in our reforms and not affected. We might have to fine-tune some of our reform plans, but it is consistent reform plans empowering the private sector, and that's why the recent figures, for example, of the private sector investments that grew from a 40% of total investments in Egypt to around 58% during the latest quarterly figures. When we get to look at the industrial growth rate of the industry sector in Egypt, it grew by an average of 9% during the last 24 months. All of this resulted in a growth rate of 5.2%, which in itself is a driving force and attracting investors to participating in a young population. 70% of the population is under 40 or 35 years old, a vibrant economy, and so on and so forth.
Minister, I've only got 10 seconds left. I've had so many people ask me the same question. Do you know where Mohammed Salah goes next? That seems to be like the most important question.
That is the most important question, and I would have loved to know, but unfortunately I don't know.
Minister, you're a gentleman. Thanks for giving us some time this morning. We appreciate it.
Thank you.
Enjoy your time in Washington, D.C. The Egyptian Minister of Investment and Trade, Mohammed Farid Saleh. Up next on the programme, we'll catch up with Rieder of BlackRock, the Republican Congressman French Hill, Joyce Chang of JPMorgan, and the former White House senior advisor Amos Hochstein. The second hour of Bloomberg Surveillance up next.
We haven't lost U.S. exceptionalism.
The consumer has remained intact.
There has been a pullback in labor demand.
Inflation expectations in the near term obviously are rising.
The economy is still showing signs of weakness despite the comments about resilience.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a record-breaking run in this equity market stateside. Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. A 12-day winning streak on the NASDAQ 100, and we add some weight to that run. On the Nasdaq 100 this morning, up by 0.1%. On the S&P, up by 0.2%. On the Russell, up by 0.4%. Energy has really struggled. Tech and everything else has done anything but struggle. This rally has been explosive.
Yeah, it really has been one of the fastest peak to trough, or trough to peak, I should say, markets that we've seen in recent memory. When you talk about moving from oversold to overbought territory in 18 days, that is the fastest that we have seen going back, I believe, to 2016. A question here about how durable this is and how much this indicates that the U.S. economy in particular is more independent from some of the geopolitical concerns, in particular, the price of commodities.
Well, let's start with the earnings. So the outlook for earnings has improved. It's not worsened based on the estimates. Now, whether that changes in the coming weeks remains to be seen, but let's go with it. We've had some decent guidance this week from ASML. We've had some decent guidance from Taiwan Semi, encouraging that move into the tech trade. And this week, not just about hardware, not just about the semis, also about software, which has had an incredible recovery over the last few days. So let's park tech. Then you've got the situation in the Middle East. Encouraged by the words of the President of the United States, some verbal intervention once again in the last 24 hours, claiming the Iranians are ready to make concessions. That's the claim. We've yet to see any real evidence backed up by the Iranians themselves. The US is talking about talks through the weekend. Let's see if we get those talks, and let's see if it leads to a genuine breakthrough that leads to an improvement in the flow of energy through the Strait of Hormuz.
There's been no verbal evidence from the Iranians, and there's been no physical evidence from the Iranians that they are willing to give up or capitulate, really, on what the president wants to see. He says they're ready to give up the nuclear dust. We haven't seen any of that. At the moment, the success of these talks is the fact that both sides are showing up and that they want to talk. At the moment, strikes, bombs are not dropping, but the facts on the ground have not changed for the Strait of Hormuz. And I'm really struck by what Europe's doing. Not only is Europe, the IEA, saying that they're going to run out of jet fuel, the Europeans are now preparing a coordinated action, a task force basically, to work together if they do get to that point where they're going to have to start working together to get jet fuel. KLM yesterday canceled some flights. You are actually seeing on the margins some companies have to rearrange because they don't have access to the fuel.
Yeah, markets just want to know what they have to discount, right? I mean, I think that it's interesting to note that European equity funds suffered the largest weekly outflow going back to November of 2024. So people clearly are worried about Europe. Over in the U.S., people are saying as long as things don't get worse, we know how to game out some sort of future, and we know how to understand how to discount some of the incoming data.
I think it's beyond that. There is a belief that if things get worse, it'll be so bad it's got to be avoidable, so it will be avoided. That seems to be the take, that the president is actively looking for the off-ramp, that we've seen this before. We saw it last year, and we've seen it repeatedly in between, back in the first term as well, over things like trade. But ultimately, because the president wants it, we'll get it. I'm not sure how simple it is this time around.
Every strategist we speak to says it's not simple at all, and frankly, it looks really terrible. And guess what? We're really pessimistic, and we have no idea what the markets are looking at. And the market says, well, if you take a look, bombs are not being dropped. So guess what? It's getting better. At least it's not getting worse, and that's enough for us.
Equity futures on the S&P getting better once again. Addison way to a record-breaking rally, up by 0.25% on the S&P 500. Coming up this hour, we'll catch up with Rick Rieder of BlackRock, with the Nasdaq on a 12-day tear, the Republican Congressman French Hill as the Fed chair confirmation hearing looms, and former White House senior advisor Amos Hochstein as President Trump bets on a weekend breakthrough in the Iran war. We begin this hour with stocks sitting at record highs as investors eye a potential US-Iran truce. Rick Rieder of BlackRock writing the immense disruption of trade and global supply conditions will be what truly influences market pricing. Rick joins us now for more. Rick, welcome to the program, buddy. Always a privilege, a pleasure to catch up with you, sir. This move that we've seen in this equity market, we've thrown so much at the stock market over the last several months. AI disruption, private market jitters, and now the Strait of Hormuz remaining closed for almost 2 months now, Rick. And here we are at all-time highs. Does that bring you comfort or make you nervous?
Good question. I'd say a couple things. First of all, I think what it tells you is the technicals in the equity market are extraordinary, and the earnings numbers that are coming through are pretty powerful. And so, you look at the U.S. economy and you look at what's, I heard at the beginning of the show talking about the economy's weak, economy's strong. Actually, the parts of the economy and the primary drivers are doing quite well. You look at tech. You look at some of the numbers yesterday that you cited, and you look at these earnings growth. I was looking at some of the semis. You're talking about 97% earnings growth year on year. Unbelievably powerful numbers. And then you look at, the high-end consumer, that consumption. You look at retail sales when you break it down. Pretty darn good. So you've got an economy, and by the way, you've got, housing's not in good shape, lower income's not in good shape. So that is what it is. But what drives the equity market is in pretty good shape. And the technicals, so you had this period of time that nobody wanted to buy stocks. And then you realize, I've said it before, you're going to have an IPO calendar this year that maybe is a couple $100 billion, maybe. We're going to buy back $1 trillion of stock this year. So we're actually, there's not enough stock to buy. So it's just a pretty, you talk about how explosive this is. You realize people sit on their hands, I don't want to do anything, particularly in tech. And then all of a sudden, maybe a little bit of better news, the earnings come in, and then you create this. The technicals and equities, by the way, it's completely different when you think about the treasury market, et cetera, because we're getting, we get $520 billion a week of supply. It's, it's amazing in the equity market how good the technicals are.
Rick, is there a contradiction in the fact that we're seeing such explosive confidence in equities? You're seeing so much cash out there that are looking for places to go. And at the same time, people are expecting inflation to come back down to 2% over the next 5 to 10 years. Does that seem contradictory?
No, I think, and I've been doing this for a few decades. I've never seen a productivity revolution like this before. So you go through, almost every company I look at, you see a similar dynamic. I can grow my top line revenue, let's say it's 4 to 10%. Obviously, tech is significantly more significant than that. But then if I keep my labor static to down, and then if I can get my cost of goods sold, and you see this in M&A, if I can create synergies, I can run a higher operating margin. If you can run a higher operating margin, then my ROE is significantly higher. And so then it just keeps driving this dynamic. So you think about and by the way, we haven't really seen automation, AI really kick in yet. So I think, there's this transmission. Part of why I think big cap stocks are so powerful is you're building a moat because you utilize data so effectively. We're seeing productivity take place. It buoys earnings. Companies do great. By the way, the counter of that, it's not great from an employee point of view. You're seeing that play out, which is part of what affects the interest rate transmission. So it's a really good story from a productivity and a corporate earnings point of view, not so much for the broad population.
So, Rick, how bullish are you right now? It sounds like you're incredibly bullish on big caps. Are you essentially going all in? Do you think it is a time to go into equities over bonds, to go into equities over cash, to go into equities over commodities?
I'm not that bullish, but I think we are long the equity market. One of the things that happens when you had what happened a few weeks ago when volatility spikes, you can't really. It's hard to have a very long equity position because you can't manage your risk using the volatility markets. Now vol has come down. It allows you to run a bit longer equity disposition. And so, I like equities. If you said to me, let's look at the credit markets, you say, gosh, where is high yield? Where's investment grade credit? And I say, okay, I've got some beta that I could put in a portfolio. Look at where spreads are, investment grade credit, not interesting. High yield, it carries well. Spreads are not that interesting. So I said, gosh, I'm going to take my beta and orient it a bit more towards the equity market or more towards the equity market where the earnings growth is explosive. I got convexity to the upside and I can manage the risk. That's a better, in a portfolio construct, that's a better disposition than I think than parts of the credit market are today.
Rick, how do you think the Federal Reserve is thinking about all of this, especially given the fact that we are seeing higher energy costs in the United States? Not as high as Asia and Europe, but they are still ticking higher.
I'll tell you, there's a pretty extraordinary point in time. And, part of what I was talking about productivity and the employment dynamic. Listen, I think the Fed will be on hold and watch the data. And by the way, you're going to see, and we are seeing what will be some, particularly at headline inflation, some heavier numbers on inflation. I think what the Fed has to do and the ECB has to do is think about you having a supply shock. This is not a demand-driven inflation. By the way, you think about what's happening to lower income, middle income people. You're getting hurt on food costs, fuel costs. Why would we raise interest rates to raise your mortgage? It doesn't make any sense. So I think what your synopsis is around that is, gosh, I'll stay on hold for a bit. I'll watch the data. I think the ECB should do the same. Maybe they get ahead of it and hike a couple of times. But I think, when we talked about before, look at the housing numbers this week. You look at existing home sales. When the mortgage rate shifts up, home sales come down. And then you look at the breakdown of retail sales, what's happening. The dispersion keeps growing. Lower income, middle income having a hard time. That's where the interest sensitivity is. So, listen, I think the Fed has to get the rate down. I still think you'll get a couple of cuts. Do you push it back a little bit? Yeah, maybe. But you're talking about a very two-speed economy where interest rates really affects things. Housing, small business, lower income, and it's part of why I think the rate can come down.
So, Rick, let's look across the curve right now. If the Fed's going to stay on hold, that's going to anchor the front end. We've seen a lot of that in the performance of fixed income and Treasury yields over the past few weeks. If you go further out along the curve, it just feels like the 10-year is anchored around 430, which was the upper end of the pre-war range. How does your thinking sort of adjust when you talk about what's going to happen with Fed funds and the relationship between that and how it informs your view of how we'll get some performance further out along the curve?
You know, I got to tell you, Jonathan, I mean, when, you know, I hear people come on and say, I think rates are going higher, I think rates are going lower. I actually find the 10-year part of the curve from an asset allocation point of view not interesting. As you said, but by the way, my colleague Russ Brownback talks about on your show all the time, if you go back over the last year or so and you look at the end of every quarter, you look at the end of the year, we pretty much hover around 425, maybe 430. But it's pretty unbelievably stable. There's a lot of discussion about what do you do with the 10-year point. I do think there'll be initiatives, and I do think when Kevin Warsh is confirmed, I do think you'll see a dynamic where can you contain the 10-year point of the curve? Can you keep mortgage rates down? Are there initiatives to actually pull that mortgage rate down that you can have through fiscal stimulus? That's really powerful. My sense is that 10-year note will drift lower through this year as you maybe get the funds rate down a bit. Can you keep the 10-year alongside of it? But I will tell you, Jonathan, in our portfolios, I say, particularly for the back end, not interesting. I just want to, what I try and do is keep my front to the belly yield curve exposure, and I just clip coupon. Like this is a year, like if we can just keep giving clients 6.25 type of coupon, type of yield, which you could do without compromising rating, I'm just going to keep staying there and then, let people, get excited about where we're going in the back end of the curve.
Rick, I've got to ask you, what kind of initiatives would bring down rates, yields at the long end of the curve?
So by the way, a bunch of things. From the Fed point of view, you can use your balance sheet effectively. We have 89% of the debt of the Treasury markets in the 0 to 2 year part of the yield curve. It's actually not that much out in the back end. The Fed can actually be very, very effective in how you manage the back end of the yield curve. Second thing you do, you see that the administration through the GSE program is actually buying a huge amount of mortgages, a couple $100 billion mortgages. You can actually do a bit more with regard to that. There are things you can do in terms of creating initiatives to stimulate housing, home builder incentives, et cetera, that pull that mortgage rate down. There's a whole series of things. Listen, I mean, you look at existing home sales, which you talk about, you look at how there's not enough inventory of houses today. It influences labor mobility to the negative because we don't have enough inventory. People can't move. It influences we don't build enough houses. We don't put enough people to work in shelter. And by the way, you can't bring down shelter inflation because we don't have enough houses. There's tremendous motivation and, quite frankly, the initiative to actually bring down housing costs and to build more inventory to bring down that mortgage rate. I think it has much more benefit than people give credit to.
Rick, appreciate your time. It's always good to hear from you. Don't be a stranger. Rick Rieder there of BlackRock. Thank you, sir. Thank you very much. He's been hot on that point for quite a while, that we need to do something about the pricing at the long end of the curve because of the influence that has, the outsized influence that has on things like housing.
Yeah, and the reason that the Fed should be cutting rates, in his view, is because it disproportionately affects the real world. As he was talking, I was thinking, he's running. Do you think so? I think he's running. No, I mean, honestly,
aren't we done with that?
For Fed chair, but there are other things, but ultimately,
other things. Wow.
Well, I honestly, Rick, I'm sorry, I'm just spreading rumors. But to me, the real issue is what you hear from so many different people on Wall Street is there is this huge dichotomy, and something needs to get done, and it isn't necessarily from their world.
Let's give an update on news elsewhere this morning. With your Bloomberg brief, here's Scarlett Fu. Hey, Scarlett.
Good morning, John. President Donald Trump says the war in the Middle East could end soon. Trump says it may not be necessary to renew a 2-week ceasefire with Iran before it ends early next week because the war could be over before that. He also said Iran and the U.S. might meet for a second round of negotiations this weekend. The gridlock in the Strait of Hormuz is sparking a surge in traffic at the Panama Canal. Tankers and cargo ships in the waterway are facing a wait time of 3.5 days. Sources telling us here at Bloomberg that one tanker paid $4 million to jump the line. And Netflix shares are lower in the pre-market after the streaming company's second quarter forecast missed analyst estimates. Netflix also announced its co-founder and chairman, Reed Hastings, will step down from the board after 29 years. That is your Bloomberg brief. John.
Hey, Scarlett, thank you. More from Scarlett later this hour. Up next on the programme, making the case for Kevin Warsh.
He certainly wants to cut rates. I've been watching him for a long time. But he's very smart, very good. He was the central casting guy that people wanted. Looks don't mean anything, but he's got the look, right? He's got the whole package, and I think he's going to do a great job.
Up next, we'll catch up with the Republican Congressman French Hill from Washington, D.C. this morning. Good morning. Stocks up again by 0.25% on the S&P 500. Record highs at the close yesterday and added some weight to the rally on the NASDAQ, up by 0.2. Under surveillance this morning, making the case for Kevin Warsh.
He certainly wants to cut rates. I've been watching him for a long time.
Did you have any concerns about his hawkish history of pushing for rate hikes?
He's going to want to do the same thing. I think that, yeah, I've had times when I think you've had to really have rate hikes too. But he's very smart, very good. He was the central casting guy that people wanted. Looks don't mean anything, but he's got the look, right? He's got the whole package, and I think he's going to do a great job.
So here's the latest this morning. Kevin Warsh's confirmation hearing set for Tuesday. The DOJ investigation into the Fed's renovation project threatening to stand in his way. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Good morning. Well, Kevin Warsh will be in front of the Senate Banking Committee as Senator Tom Tillis holds firm he will not vote to advance the nomination until the legal matter against Fed Chair Jerome Powell is resolved. And he really could make good on his threats. Republicans only hold a 13-11 majority. Now, I've heard it floated before that maybe Republicans would look to use a discharge petition to bypass procedure. But I have to say, I called up a few sources on Capitol Hill, and they are saying that that would be a lot easier said than done for a list of reasons, including that would likely require what's known as cloture being invoked, and that requires a 2/3 majority, which means Democrats would have to get on board. And at this point, they're not. In fact, we're seeing a last-minute push by Senate Democrats today to try to delay next week's testimony. Now, John, as you know, the Trump administration was offered a potential off-ramp here after a judge last month moved to block the subpoenas in this case. But even as we know that the legal bar is very high to remove a Federal Reserve official, the Department of Justice is still vowing to appeal that decision.
Tyler, thanks for breaking down the details. We've got the perfect guest to have this conversation. The Republican Congressman French Hill joins us around the table, also the chair of the House Financial Services Committee. Mr. Chairman, it's good to see you.
Great to be with you, and great to have you all three in Washington.
Thank you for hosting us. Thank you for hosting us, sir. Let's talk about this. I've asked so many people this question. I'll ask it you. Why isn't the president taking the off-ramp and getting his man confirmed at the Federal Reserve?
Well, it's what I recommend. I mean, I said back in January that I didn't think Jay Powell had done anything criminal, and that it was a distraction to have the DOJ do that investigation, which is, as I've said many times, doesn't exempt the Fed from criticism. I've had plenty of things that I think that Jay Powell or the Fed board should have done differently over the years. But it's time to move on from this. The petitions to the court have been rejected, and I think it's time to move on from the case and put our attention around getting Kevin Warsh confirmed by the United States Senate.
Do you think there's enough pressure right now on the White House for the president to take the off-ramp?
Well, I would hope so. You see this letter that you just had the reporting on from the Democrats, and Senator Tillis is still very committed to holding his support of the nomination until this is behind us. The House committee or the Senate committee can continue to look at the investigation of the building if they want to and that kind of thing, but when it comes to our oversight of monetary policy, our oversight of the Treasury market structure, the face of just doing our routine work and overseeing the Fed, I'd like to see the new chair confirmed and let President Trump have a new partner at the Fed. Let Treasury Secretary Bessent have a new partner in bank supervision and monetary policy. It's time, and I think it's important to move.
It feels like the president is doubling down. Maybe he doesn't want to lose face. So what could potentially be an off-ramp? I mean, he likes deals. Is potentially, I'm going to drop the DOJ case, but Jay Powell, you're not staying on till 2028?
Well, I think Chairman Powell is interested in seeing his replacement confirmed, and I think Chairman Powell is probably interested in going on to the next phase of his career and his life, quite frankly. So,
but you don't think he's staying on as governor?
Well, I think that depends on, according to Jay Powell, that's how he's inclined to stay on, according to Jay Powell, if Kevin's not confirmed and if this case is not dropped. So this is why I think if you're for the Trump administration and the Treasury moving on, having an economic policy that's in alignment, then I think it's in the president's interest to see the case move on, and let's go forward with the Trump administration's appointees at the Fed.
In the meantime, Rick Rieder of BlackRock was just on, and he was talking about how he would like to see whoever comes into the Fed next work with the federal government on initiatives to try to get mortgage rates lower, try to get benchmark rates lower on the long end as well, in order to keep affordability under check. What currently is in discussion on the House Financial Committee, given the fact that this has got a fiscal overtone as well as potentially a broad-based different agency initiative?
Well, I think the best way to make sure that takes place is to make sure inflation is well anchored, and I think we do that by taking steps on the supply side to see that the big beautiful bill from last year on the tax side is fully implemented. Let the Americans, both in business and at home in their households, reap the benefits of those important supply side tax changes, and let's continue our work to right-size regulation. Those things would free up more capital to the housing sector, particularly. 6 out of 10 home construction loans are not made by the biggest banks in the country. They're made by banks under $10 billion. And that's what I've had as a focus of the committee. Let's have a deregulatory supply-side housing bill, which the House has passed and we're negotiating with the Senate on. Let's continue our effort to put in law these tailored regulatory issues that allow our regional banks and community banks to thrive, because they're under the burden in a lot more significant way when it comes to capital levels, return on investment than the biggest banks in the country are. Putting that into law, I think, does exactly that. It helps anchor inflation, moves capital into the economy, and I think that allows short-term rates to fall, and that in turn has a modest impact on pulling down that 10-year rate, which is so important as a benchmark.
Let's finish on financial services. What are you hearing about Mythos?
Yeah.
And how dangerous this might be? What's your understanding of things right now?
Well, the committee has, both Ranking Member Waters and I are concerned about that. We've actually asked the Treasury, for a brief there. We have noted the Treasury Secretary's engagement and the Fed with the largest financial institutions in the country. When I meet with the private sector, I hear from them that Claude is a very effective AI partner and that they've been most impressed with it. And that they want to get into a mode where they can see and determine any risks associated with the Mythos product. And that speaks to my philosophy about AI to begin with. We ought to let the compliance sector, meaning the supervisors, the regulators, and the private sector work in a sandbox type environment, sheltered from someone's network, to see what the impact of these large language models are, because they bring tremendous benefits to consumers, to business, ahead of us, but they also have these risks, and we should make sure that all of our network operators have full understanding of it.
They're making some bold claims ahead of IPOs. They've got an interest to really hype this up over the next 12 months. It's hard to understand what's real and what isn't. In the 30 seconds we have left, do you foresee any hearings to get some of these CEOs in front of you guys and for the public to hear what's real and what isn't?
Well, we've started our hearings on AI, both from a regulatory compliance point of view, and we have done roundtables, meaning not public hearings yet, with the business sector, both the tech sector and the users, and I think you'll see us continue that work this year.
Mr. Congressman, thank you very much, sir. Good to see you, sir. As always, thank you. We'll be back soon. Congressman French Hill there on the latest in the financial services sector and with the Federal Reserve. Up next, Joyce Chang of JPMorgan with risk appetite remaining strong. Four-day winning run on the S&P 500, 12-day winning stretch on the Nasdaq 100, the longest going back to, I believe, July 2017. Equity futures up so far this morning by 0.25% on the S&P, on the Nasdaq up by 0.2%. The Nasdaq over that period higher by more than 13%. It has been a very, very sharp and quick, fast recovery in this equity market. As we count you down to the open about 2 hours away, let's get some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. A painful morning for Netflix, down 10.6%. Despite a solid first quarter, the issue was their outlook for second quarter. That guide missed expectations, missed the lofty expectations, given that they've been raising prices. Investors wanted more. We also learned that Reed Hastings would be stepping down from the board. So that's down more than 10.5%. 1.5%. Elsewhere this morning, we are looking at Microsoft and Stellantis. Both of them are up. Microsoft has been on a huge run along with all software, really. But specifically this morning's news, the two of them teaming up to get more AI into Stellantis' cars. It is a company that has long been trying to effort a turnaround. Those shares up 2.7% in the pre-market. And finally, some other earnings from Alcoa. Here we had a miss, despite the fact that the price of aluminum is up 15% since the war started in Iran. Instead, what you got from this company was higher expenses and costs. JPMorgan pointing out that they had some shipping issues, some of the problems around that stemming from bad weather. So shares down more than 2% in the pre-market, John.
Danny Berger. Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump claiming Iran has made key concessions in negotiations and a deal to end the war could be announced soon. The president saying the two sides may meet for a second round of negotiations later on this weekend. Elsewhere, the former Treasury Secretary Hank Paulson calling on the U.S. to prepare a backup plan to avoid a future collapse in Treasury demand.
People say, when are you going to hit the wall? I obviously don't know. It's impossible to know. When we hit it, it will be vicious. So we have to prepare for that. I think we need an emergency break-the-glass plan so it's ready to go when we hit the wall.
Paulson adding the U.S. is better positioned to weather the Iran war disruption than anyone else. And finally, the Anthropic CEO, Dario Amodei, meeting with the White House Chief of Staff, Susie Wiles, today. Axios reporting the two will discuss the company's AI fight with the Pentagon. The administration looking to make a version of the company's AI model, Mythos, Annmarie, available to federal agencies.
So this is really a confusing story if you're looking at it, like how the U.S. government writ large is using Anthropic. It's 1 foot forward when it comes to trying to use it in certain agencies, but it really is a step back when it comes to this massive fight that Anthropic is having with the DOD. The DOD coming out and saying it's a supply chain risk, as we heard from Gregory earlier today from CSIS. That's what you give shell companies that are basically a Chinese company that is trying to maybe get into the supply chain of the United States. So this is a difficult moment. Susie Wiles potentially could try to basically patch this up between Emil Michael and Secretary Pete Hegseth and Dario Amodei, because clearly the government sees use cases for Anthropic in other areas.
How awkward is this? That so many people in government right now are using Claude, are using all of the Anthropic tools as an integral part of not only national security, but also the ongoing hot war in Iran. Yes, we have a ceasefire right now. So there is this sort of awkward feeling of like, okay, well, you know, we kind of have designated you an evil child, but we also are using you and need you. So can we just patch this up? And there is this sort of undertone right now in Washington, D.C. here.
One thing I hear a lot about this fight, I mean, Emil Michael joined us the morning after he put out that tweet saying Dario has a God complex. One thing I hear from a lot of people is that there's a ton of egos involved in this on all sides. And maybe Susie Wiles can cut through those egos and actually be the one that brokers this truce.
There's also a massive potential conflict of interest, and I've been going on about this now for weeks and weeks and weeks. They have every interest right now to hype up the potential of this company going into the IPO potentially later this year, which is why governments need to aggressively figure out what is real and what is hype. Now, from what we understand from financial services representatives and the conversations we've all had over the past few days, a lot of this technological progress is real. Much of it could be dangerous. It could expose vulnerabilities in the financial system. People are concerned about that and looking to get ahead of it. Let's hope they do. But on the other hand, we can all see why they want Anthropic to be the front page of every single financial publication over the next several months, because there is funding rounds potentially that are going to take place over the next 12 and an IPO that could take place as well. And it could well be that this company has a valuation approaching $1 trillion.
There's a very awkward conversation that needs to be had, which is how do you deal with a private sector that is so far ahead technologically of a government that needs to depend on it while at the same time keeping it in check, and a sense of financial interest tied to said company at the same time that it could potentially transform the way we do business. And ultimately, those tensions are coming to the fore in some of these disagreements, but I think that the underlying one is correct. How do we understand what's truth and what's marketing? And that, I think, has been a big challenge.
What's real and what's hype? Right now, this equity market, those real record highs are on the screen right again, adding some weight to them on the S&P 500, on track for a third straight week of gains. Markets optimistic about an end to the war in Iran. Joyce Chang of JPMorgan writing the speed and magnitude of the relief rally since the ceasefire suggests that risk appetite remains strong and easy financial conditions are still a dominant force. Joyce joins us now for more. Joyce, welcome to the studio. Good morning.
Great to be here.
It's good to see you. You've been here the last few days, I believe, at the IMF World Bank spring meetings. What's the number one takeaway for you so far?
Cognitive dissonance, so heightened geopolitical risk, but also bullish markets. Positioning for fat tail risk are gone. We're going to get some type of ceasefire agreement soon, even if it's light on details. So I think that is the prevailing mood right now. And then there's the AI story. That's still taking a meaningful step up. CapEx is still strong. Now, I worry that is the narrative now, but I worry about the risk around that. So the trade we're in now is fat tails are gone. We're going to get some kind of deal. A lot of people looking at this like last April, is this going to be V-shaped like Liberation Day, like a trade war? But, we have to really see how these negotiations are going. We have to understand the Iranian position and whether this can be done that quickly because the clock is ticking. We're going through inventories. We have 13 million barrels per day offline. So if this goes longer than what market is expecting, that's going to lead to, I think, a considerable amount of disappointment here.
So people have reflected on the 2025 comparison, Liberation Day, April 25. I wonder if there's similarities in the price action to, say, 2020. I've been trying to work out if this is February 2020 or April 2020. In February, we were at all-time highs, oblivious to what was about to happen. In April, we had this vicious rally, hopeful about the future, and if you were late to get on board, you missed out on some big gains. Do you think it's one or the other right now?
Well, I think that's been the pattern, and this is why this drawdown wasn't comparable to COVID. It wasn't comparable to Russia, Ukraine. It wasn't even comparable to Liberation Day. It's come back so quickly every time. So the drawdown this time was much less. But it's very different, I think, than Liberation Day because that was unilateral. You could sort of begin to bring down the tariffs on one side and take that pressure off. You need both sides at the table. It is like COVID in that we think the way that the pain spreads is, not one shock, it's more sequential. So it started in Asia. Well, it moved to Africa and then to Europe. And that's why the clock matters here, because you're running through a lot of these inventories and reserves right now. Probably taken about 6 million barrels per day offline just since this started. So that is something where the market is thinking, well, something will happen relatively quickly, 3 weeks, 5 weeks at the maximum. But when we look at negotiations with Iran, that they have not been that quick. And these issues are very complicated, and we don't really hear the Iranian side of it. So I worry that the market, could be pricing in a lot out of the headlines we're hearing, but it's more complicated than that.
I like your framing of cognitive dissonance, and I wonder how much is dissonance between the physical world and the financial world. The idea that in the physical world there are real constraints, as we've learned since COVID and beyond, while in the financial world it seems like there's a lot of liquidity, and actually financial conditions are really easy. How do you square those two ideas and just how easy financial conditions really are?
Well, financial conditions are easy. I mean, there is demand not just for the S&P 500, but because there's demand for diversification. I think that emerging markets will benefit here. Real assets are benefit here. I mean, there are easy financial conditions that are, being put to work. But that doesn't change the physical constraints or the fact that it's very uneven as far as how different regions are being impacted, with the Southeast Asian, South Asian countries being impacted the most. But part of this is, we've had this pattern where everybody said, oh, well, worst case, it could be a war, or we could challenge Fed independence. And those things all happened, and the market still rallied. But, underpinning of all of this really is the AI CapEx cycle. I mean, you really can't talk about this and, divorce it from that picture. I mean, we have CapEx up from 14 to, more than 18%. And that we have not seen that the AI CapEx investment seems relatively war resistant here and still very much intact.
When we ask different executives of banks, of other companies, whether they have some sort of provable return on investment from AI, no one says yes. Well, so at what point do you start needing to see that in order to justify the ongoing investment to this degree?
So right now, you're not at that monetization phase where people are even discussing it. They are still at the demand, the compute demand, and just meeting that need. And I think with all of the events that have happened over the last few days, it's even a more meaningful step up on those questions. So you get there, but I still think when you ask a lot of people in the marketplace where we are in a scale of 1 to 10 on where we need to worry about the questions that you're asking, and they're saying, well, we're still at this halfway mark where just meeting the demand for compute is sort of the number one investment that's going in right now. So I think markets are, looking at ceasefire, looking at the AI cap cycle, have actually quite a lot of cash on the sidelines. And one thing I would say is just from meeting with all of the policymakers around the world, we would do 10-year bunds over 10-year treasuries. We think core Europe came in with inflation at target, relatively low unemployment, this is one where Europe looks stable. Not saying that there's going to be a single market or something that is a massive change, but I think investors are saying, look, EMFX, emerging markets, also has lower fiscal deficits. Sort of don't have current account imbalances. So I see much more demand for diversification. It's not just the AI story as well.
How different are your conversations with whether or not you're speaking to a participant from Asia or the United States right now?
So I think that there's a lot of questions that we are getting from Asia and also from Europe on whether treasuries are a flight to quality. When we've said dollar is a safe haven, they said, no, it's terms of trade. There is no alternative. But that diversification story is very real. So there is a big difference between talking to U.S. investors who are really looking mostly at the S&P 500 and Asia, where they are actually feeling more of the physical pain of this and asking about diversification and also asking about, are U.S. treasuries a safe haven? Am I better off buying high-grade credit rather than buying sovereign debt? Or if I'm going to buy sovereign debt, should I do 10-year bunds instead of 10-year treasuries?
My response to that, Joyce, would often be it depends on what the risk is. If I'm facing a demand-side shock, typically I'd expect the bond to perform to provide that risk mitigation. But what we're seeing more frequently over the last several years are supply-side shocks. And I'm not sure whether the risk mitigation characteristics of treasuries or for developed markets, sovereign fixed income perform in quite the same way in the face of supply-side shock.
We have seen the breakdown of that correlation since 2020. And this is why we're really seeing more of a demand for real assets. But that's also been uneven, if you look at what has happened with gold. So I think part of the reason you haven't seen a lot of de-risking is that there isn't a very good hedge that you can put on in this environment. But there is still the appetite to look at AI and look at that CapEx cycle and a belief that that is a driver, at least through the end of this year and into next year. And that CapEx is already sort of in place and in motion right now.
A lot of portfolios anchored to that story, that's for sure. Joyce, it's good to see you.
Great to see you.
Thanks for being here. Thank you. Joyce Chang there of JPMorgan. Equity futures right now on the S&P 500 higher by 0.25% with an update on stories worldwide with your Bloomberg brief. Scarlett Fu's back with more. Hey, Scarlett.
Good morning, John. President Donald Trump says Israel and Lebanon agreed to a 10-day ceasefire. Trump says he held, quote, excellent conversations with leaders of both countries. There was no immediate confirmation from Israel or Hezbollah. UK Prime Minister Keir Starmer is again facing calls to resign over his appointment of Peter Mandelson as ambassador to the U.S., despite links to China, Russia, and Jeffrey Epstein. Starmer was forced to acknowledge on Thursday that the Foreign Office gave Mandelson security clearance even after objections from vetting officials. President Trump's 250-foot triumphal arch clears a key hurdle. A federal arts panel approving early designs for the project. The arch will be built in honor of the country's 250th anniversary and will feature eagles, Lady Liberty, and a line from the Pledge of Allegiance. That's your Bloomberg brief. John?
Hey, Scarlett, thank you. More from Scarlett in about 30 minutes' time. Up next on the program, striking a deal with Iran.
The stock market is good. The oil prices are coming down. And it's looking very good that we're going to make a deal with Iran. And it's going to be a good deal. It's going to be a deal with no nuclear weapons.
Up next, we'll catch up with the former White House senior advisor, Amos Hochstein, live from Washington. You're watching Bloomberg TV. Equities are positive. The S&P 500 higher, adding to a record-breaking rally once again. 12-day winning streak on the Nasdaq, 4 days on the S&P, 3-week winning streak potentially on the S&P 500. Haven't seen that all year. 2-week losing streak on WTI, edging lower for 2 consecutive weeks for the first time since the war started. Bramo, crude, 96, WTI, 91.
Yeah, even though you've got people like Stephen Cook coming out and saying that you could see the Strait of Hormuz continue to be closed for the next couple of months. But right now, the market has moved on. The extreme bad case hasn't transpired yet. And so right now, financial markets are saying, happy Friday. We're going to just take it somewhere else.
Under surveillance this morning, striking a deal with Iran.
The blockade has been incredible. It's held. The stock market is good. The oil prices are coming down. And it's looking very good that we're going to make a deal with Iran. And it's going to be a good deal. It's going to be a deal with no nuclear weapons. They're not very high. If you look at what they were supposed to be in order to get rid of a nuclear weapon with the danger that entails. So the gas prices have come down very much over the last 3-4 days.
So here's the latest this morning. The U.S. blockade of the Strait of Hormuz entering its 5th day. The White House signaling a second round of talks may take place later this weekend. Joining us to discuss is Amos Hochstein, the managing partner at TWG Global and the former White House senior advisor under President Biden. Amos, it's good to see you, sir.
Great to see you all here.
Good morning. It's good to be with you in Washington, D.C. for once. That's new for us, I think, right? I think so.
For you two, not me, but yeah.
OK, good. Got that out of the way. Don't know why we went there. Alice, let's get to it. So we've got the president saying we can secure a deal pretty soon, and there might be talks over the weekend. We've got foreign leaders of Arab states and, for that matter, Europeans as well, according to our sources here at Bloomberg, suggesting it could take 6 months. What's a realistic time frame to secure a peace deal with the Iranians?
Well, first, it's always a question when the president says very soon. Is very soon closer than almost done, almost complete, which was his statement 4 weeks ago? Or we're almost done, or we've won the war. So I think the president's done a very, very good job on the PR and marketing side. He understands markets very well. He understands the psychology of it. Markets operate based on optimism and hope. As long as you give the market hope and optimism, it will give you back the love. And so he does that every sort of usually on Sunday, Mondays, and Fridays. And no, it's true. I mean, look, the last 4 weeks. And by the way, I don't say this with cynicism. I actually think as the President of the United States, he's managing a crisis. And if the markets are down, his window is narrower and his capability and his capacities and capability is narrower. So, and the Iranians get leverage. So he's doing everything he can to keep the markets up. And that's why for 4 weeks straight, he has said, we're probably done in the next few days.
Well, given the fact that oil prices are depressed at the moment and you have records on stock markets, does this mean maybe he will be more emboldened? We could see a more aggressive Trump?
So let me just adjust what you said a little bit. Oil prices are not down.
On the screen, they are.
On the screen, they are.
You're right, not physical. But
the physical price of oil is not down because despite all of this, between the two blockades, there's nothing going through the Strait of Hormuz now for several weeks. I just came back from Hong Kong this week at an Asia conference, and they're talking about which day are we going to be shutting down airports. Singapore's said this week that they growth turned negative because of the energy crisis. So this is a regional crisis, not a global one at the moment. So oil prices are actually very, very high in the real economy. You have companies, manufacturers in Japan, Toto announced that some of the line of production is coming off because they don't have inputs. So, but I do think that because the market down, the oil prices on the screen down, for President Trump, I don't know, more emboldened, but I think he feels tougher, that he has a better hand in the negotiations. So he doesn't want to go back to fighting. The Iranians don't want to go back to fighting. But both sides don't want a deal that makes it look like, we lost. I mean, if you take the Vice President Vance's comments from last week, that this was about 5-year versus 20-year moratorium on enrichment, well, that's basically the Obama-era JCPOA. That was 15 years. Maybe that's the compromise.
Is this basically JCPOA with a toll?
Well, I hope not, because the toll would be terrible. The nuclear deal we could have gotten before the war, if we get a victory that the Straits open, that was a crisis we didn't have. So that's where I hope we get to a good solution here on nuclear, on missiles, on regime, on support for proxies, because at least we would get something out of this war.
When it comes to, you had a moment of reflection there. You like what the Trump is doing. Do you almost wish you were President Biden when gasoline was $5 a gallon, went out and jawboned the market?
Look, we were very different presidents, very different administrations. And jawboning the market is part of the job. I think this is a different place where the market wants to be positive because the AI story is such a strong story. And what you don't want is a disruption here on the physical old school market to disrupt the future type of market.
Which is something that we experienced just about 6 years ago. I'm just wondering, based on what you're seeing over in Asia, how long of a time frame do we have before that starts to migrate first to Europe and then to the United States, in not necessarily the form of energy in the United States, but maybe in the form of chips, maybe in the form of other products that are coming from Asia?
I think you're going to see it in sort of the manufacturing of physical goods, right? Aluminum prices are really, really high. Steel prices are going to go up. But it's going to take time to come here, a few more weeks. Energy crises are the slowest moving crisis because when they happen, when a disruption happens, I still have ships on the water coming to me for several weeks. Then I have inventories that have to go through. So it takes a really long time to go through the physical market where I get rid of the inventories that are already there before the shortage. But once it hits, it's really vicious, right? Because then there's no ship right now on the water that's going to Asia. So if you're a country that's gotten last shipment, you're like, damn it, I still have now, even if the war ends and the straits open, I still have 3, 4, 5 weeks after that before I get anything. So, and think about it, a plane leaving the United States going anywhere can't take its fuel with it. So even if we have jet fuel in the United States, it's not like I carry my supplies with me. If the airport where I'm going doesn't have it, then I'm not doing it. Lufthansa in Europe just announced, yesterday, they're cutting a whole bunch of flights. Not because they've already run out, because you don't want to get to the point of running out. So that's how it's going to move across from Asia to here. You have multiple countries at 4-day work weeks to conserve energy.
Across Asia.
Right? So at some point, the question is going to be to the market, if the purchasing power in Asia for American services and goods will matter at any point. Or maybe we're just becoming more really America first and alone, where we're building an island. And how doable is that?
Amos, it's good to see you.
Good to see you too.
Sobering thoughts, but good to see you. Amos Hochstein there, the managing partner at TWG Global and former White House senior advisor under President Biden. Reminds me so much, just echoes of COVID. Obviously, there are massive differences between now and then. Certainly the nature of the crisis is vastly different. But just the price action. I just remember February of 2020 at all-time highs on the S&P 500, if my memory serves me well, February 20th. Going into that weekend, and then things started to shut down in northern Italy, and that's when the US side of things started to wake up to the potential of what was going to happen. I don't know if we see that kind of wake-up call, how close we are to that kind of wake-up call, but certainly reminds me of that period.
It reminds me of the disconnect between the financial world, where everyone says buy the dip, and the physical world, where people are saying we don't have what we need, and that's a problem.
Equity futures right now in the S&P up by 0.25%. Up next, Alex Altmann of Barclays, the former US Deputy National Security Advisor Dalip Singh, Nathan Sheets of Citi, Jason Thomas of Carlyle. The third hour of Bloomberg Surveillance, just around the corner.
We're probably in this sort of global relief rally.
Markets are pricing in a resolution.
Equity markets have started living in the future.
This type of environment, you just stay in large caps.
There's a short-term look-through in the market. That's what keeps the stock market going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures adding some weight to the rally on the S&P 500, on course, poised for a 3-week winning streak on the S&P for the first time in 2026. All-time highs and another close above 7K in yesterday's session, up another third of 1% so far this morning. On the NASDAQ, a 12-day winning run could become day 13. On the NASDAQ 100, higher by 0.3%.
If we see day 14, then all of a sudden we're going back to 2014 since the last time we've seen a streak like this. It has been one of the fastest reversals in markets history as people take a look at what had been a potential big disruption, still is the potential for a big disruption, but people have moved on. I'm struck by how multifaceted this rally really has been. You talked about software. We saw the biggest 1-week increase in software stocks going back since the dot-com bust. So you really can see a huge enthusiasm to buy things perceived as cheap.
So the market basically declared mission over, mission accomplished, the war is ending. The fact of the matter is, and I'm really struck by Amos Hochstein's conversation just now about how long this might be for the Strait of Hormuz and all the mitigation we've already seen take place in Asia and what is going to be happening in Europe. Some airlines are actually having to cut routes because of the access to jet fuel. And the fact of the matter is, what we see on our screens is not the reality on the ground when it comes to physical barrels and what is going on in the oil market.
Joyce Chang at JPMorgan put it well. Cognitive dissonance kind of sums up the story of the past 2 months, through March and through much of April. And I think sums up our conversations quite well. When we speak to someone on Wall Street, we will in about 2 minutes' time, they'll say the outlook for risk right now is positive. This market can run. It has done. When you speak to a policymaker down in the nation's capital, in Washington, D.C., particularly policymakers from outside of the United States, they are immensely concerned about what's happening in the physical world.
It seems as though the market doesn't want to price in tail risk because they've been penalized for pricing in tail risk for year after year after year, and yet the tail risks are getting fatter and fatter, and the potential for another COVID type of supply disruption is getting very real for a number of finance ministers who we've been speaking to down in D.C.
Stocks are positive by 0.25% on the S&P. Coming up this hour, Alex Altmann of Barclays, with stocks looking to build on a record-breaking run. The former U.S. Deputy National Security Advisor Dileep Singh, as the war in Iran weighs on the global economy, and Nathan Sheets of Citi Research on the path ahead for interest rates. We begin this hour with stocks adding to gains as investors watch for the next move in the US-Iran ceasefire. Alex Altmann of Barclays writing, there remains a decay profile to risk. However, the longer that Iran does not retaliate, the more positive it is for risk in the market can recay. Alex joins us now for more. Alex, welcome to the show. Just translate what you mean by that and what visibility you've got on the situation abroad and what it means for your outlook.
Thanks, John. So, really simply, we were looking at this whole situation almost like a reverse merger arb at the end of March. And what I mean by that is that the market was effectively decaying lower every day as it was pulling towards a base case that there was going to be escalation of this conflict. And we knew that positioning was very light. As, you know, we've talked about this on the show historically. And so in any eventuality of a resolution, ceasefire, basically what we've effectively seen over the course of this month to date, is that the positioning dynamic wouldn't be able to keep up with the change in narrative. And that was going to effectively force a dramatic repricing of risk. And that's exactly what we've seen today. I mean, if you look at the rolling 15-day return of the S&P, it's about 15%, it's around about 11%, which is putting us around about the 99th percentile of returns or going back to 1999. So this is pretty dramatic as the positioning is scrambling to keep up with that change in narrative.
So, Alex, typically when we talk about options decay, there's a set date for expiry. There isn't a set date for expiry of this particular conflict, and it isn't just in one man's hands. It's in multiple people's hands at the moment, Alex. Does that complicate things on how we value this market?
It does to a degree, and I think that ultimately the forward returns of the S&P have become skinnier now. We have to acknowledge that when we've gone from 64, 6,500 all the way up to 7,100 in S&P futures now. And so with that, I think it's going to create a little bit more differentiation. It's also going to create a more balanced risk-reward for equity risk. But we, again, shouldn't lose sight of two things. Number one is that positioning dynamic. And we have to acknowledge that systematic positioning, so non-discretionary investors that were effectively removing some of their equity length, are now having to put it back on, and they haven't been able to do that. That's going to create an underlying bid to risk. The second one is that just that differentiation. So you mentioned earlier about how software stocks have seen a significant rally. There are pockets of value which investors are effectively going to go after in anticipation of a catch-up trade. And we still think there's opportunities there, certainly within parts of the commodity space and indeed within the domestic US equity market as well.
Alex, we're seeing dispersion in the tech space that resembles what we saw in the dot-com bust in March 2000. And this is raising some concerns for some people that maybe it has the feelings of late stage in terms of the tech enthusiasm. Do you see anything like that, sort of concentration risk and a feeling that the market is becoming less stable?
I think we have to acknowledge that the market is becoming less stable, but I would actually argue that's driven less by necessarily dot-com analogs. I mean, ultimately, the market is trading on around about 20, 21 times, but the earnings growth profile of the market doesn't really look like the dot-com. I mean, bearing in mind, we're still forecasting as a consensus, Bloomberg consensus, as about $339 of next 12-month EPS. So that's about 18% growth. So we could debate whether you believe that number or not, but that automatically puts us into quite a different realm to dot-com in that regard. I would say that the bigger problem is, in terms of the fragility, is the fact that we've had a ballooning of fast money AUM, assets under management. And so that's just naturally driving more velocity within the market and just pushing money in and out at a quicker speed than ever we've seen before. And that's driving factor volatility, market volatility as well. And that, I think, is a different problem to what we necessarily saw, say, 20 years ago in the dot-com bust. But we have to acknowledge it, and that's one of the things that we as a team try to navigate and sort of help our clients with.
So, Alex, can you give us sort of a cheat sheet for what this weekend's going to be like for you and your team, given the fact that we are going to get some sort of discussion of talks in Islamabad, and we could see a breaking down in the peace agreement or an extension? Either one could potentially have a really significant ramification for markets. I mean, how violent could the moves be on either side? How asymmetric, given how fast-moving the liquidity has been?
Again, we have to acknowledge that we're not completely out of the woods with this. I would say that client discussions have not entirely moved on from the Iran debate here in the US, but they've certainly evolved a little bit, just trying to look beyond just the near term. There is without doubt an anticipation that a ceasefire is going to be extended, and that this effectively moves to a back burner narrative, something that's still going to rumble in the background. Just for example, like tariffs did. Tariffs still haven't gone away, but it's not like we talk about them every day. So I think there's an acknowledgement within the US investment community that there is still a fat tail, and it is fat, and it could see significant wobbles in US equity risk. But you have to counter that with what we're hearing on the ground, the negotiation that's going on, the appetite both domestically and politically to continue a war or a conflict in the Middle East. And also, let's not forget, the Congressional War Powers Act as well will potentially limit the ability for the administration to continue waging a kinetic war going forward. So, yeah, of course, there's still a physical problem with oil. We're going to be lingering with commodity issues. It's one of the reasons why, as a team, we still really like the commodity narrative, not just oil, but just the broader commodity theme of every man for himself needs to build a strategic stockpile of copper, aluminium, cobalt, everything, fertilizers. I think that's a very interesting thematic that we can still play out with, and portfolios should include. But beyond that, I think the base case for investors right now is the fact that they're looking beyond just that fat tail and acknowledging this is probably just going to linger in the background, and they need to just get back to business and studying stocks in a good old-fashioned way.
So, Alex, you're basically saying they can live with this status quo, because you're right. The appetite of the United States and Iran right now is not to continue fighting, but there's no real appetite for serious work on a nuclear deal, given what the Iranians are willing to take, and that is a huge red line for the United States.
Again, I think there's a lot going on in the background, and I'm not really in a position to comment specifically about how these negotiations are going. As we talked about the last time I came on this show, you either believe in a path of either escalation or de-escalation. And I know there's obviously a huge shade of grey between those two outcomes. But we as a team have always believed that this administration has sought a path of de-escalation for several weeks now. And the back channels would very much indicate that. So you're probably right that the deal around nuclear is not going to be easy. It's going to be fraught with difficulty. And I imagine there will still be bumps along the road, something which we talked about in previous pieces. But ultimately, the market will still look through it if it understands that there's still an improvement in the flow of traffic. That really is what it cares about, that traffic flow in Hormuz, the release of oil back into the market, the normalization between the physical market and the futures strip, and ultimately as well, just monitoring what the futures market in oil is doing. If we can go back to even an 80 handle oil environment, the US economy is absolutely fine with that. I mean, let's be very clear, right? Between 2011 and 2014, the US economy averaged $95 to $100 oil. And during that period, it averaged GDP growth of 2.2%, and the S&P cumulatively went up over 60% over those 3 years. And although I'm not going to try and make the comparison that's exactly the same, but in today's money, that would be $130 oil average, right? So if we're talking about $80 or even $90 oil, I think it's something that the US economy can comfortably stomach. And yes, of course, there is still inflation considerations. There's margin considerations too. That 339 BPS for the S&P probably needs to come down a smidge. But the point being is it is manageable. And I think people often lose sight of that.
Alex, it's good to see you. Thanks for reflecting on some of the situation that we're going through right now. Alex Altmann there of Barclays. Alex, of course, is right. $80 crude in this country is not a problem at all. It's not just price, though. It's not just a price issue abroad, particularly in Asia. It's an outright shortage problem right now that they're confronting. Whether they can afford it or not, they can't get access to some of that product.
Exactly. And it's not just when it comes to oil or jet fuel, it's LPG. It's what India is basically tethered to if they want to have cooking supplies. This is a huge problem for Asia, and we're just insulated from it in the United States. We're not feeling it the same way. But very soon, Europe is going to be feeling some of those troubles as well.
The US at the moment feels like a bit of an island, not just in financial markets.
Well, to me, it just feels like AI investment seems to be clouding and, sort of giving fairy dust over anything that might give anyone some worries. So every time that I say, well, what about this? People are like, what are you not looking at and understanding about AI? And it feels like that is the source of this incredible cognitive dissonance.
All-time highs on the S&P 500, up another 0.25% with an update on stories elsewhere this morning with your Bloomberg Brief. Scarlett Fu has more. Hey, Scarlett.
Hi, John. President Donald Trump says the war in the Middle East could end soon. Trump says it may not be necessary to renew a 2-week ceasefire with Iran before it ends early next week because the war could be over before then. He also said the U.S. and Iran could meet for a second round of negotiations this weekend. Anthropic CEO Dario Amodei is meeting with White House Chief of Staff Susie Wiles later today. Axios reports that the two will discuss the company's AI fight with the Pentagon. The Trump administration is looking to make a version of Anthropic's latest AI model, Mythos, available to federal agencies. And Apple is losing another top leader. The company's marketing executive is retiring after 31 years at Apple. Stan Ng helped create the original Apple Watch and launched the original iPod. That is your Bloomberg Brief. John?
Scarlett Fu, thank you. More from Scarlett in about 30 minutes from now. Up next on the programme, the Morning Calls, plus the former US Deputy National Security Advisor Dileep Singh joins us as the war in Iran weighs on the global economy. Live from Washington, D.C., you're watching Bloomberg TV.
We've had earnings-led melt-up in the stock market for a while, actually. The earnings expectations continue to increase at a faster pace. So the analysts didn't get the war memo, and they didn't get any feedback from the companies they follow that this is just a concern for earnings anytime soon.
That's helping to drive equity markets higher, compressing multiples, earnings, and the outlook for earnings improving through the duration of this war, which is unbelievable, and underpinning this run in the equity market. The S&P 500 at all-time highs, up another 0.4% this morning. On the Nasdaq, up by 0.4. If you speak to people on Wall Street right now, the future's bright for the equity market, anchored by this very robust, resilient earnings story. If you speak to policymakers at the IMF World Bank spring meetings, let's just say they're not in the same frame of mind of some of these traders on Wall Street.
Yeah, you know why they're not? Is because you see the IMF delegates who are having to have these meetings with different finance ministers who have their hands out, who are saying, please, give us money because we don't know how to buy physical crude to keep our economies open. That is the reality on the ground, and you can see that in the corners, and markets are saying, you're a small economy, you're relatively poor, the averages sort of discount you completely, we're moving on.
They're rationing. They're telling people to stay at home. They're asking them to ride their bikes. Europe is starting to cut routes. There is real physical shocks happening in Asia and Europe. And at the moment, the United States is just insulated and Wall Street is just looking through, even with the Strait still closed.
That is not a problem right now for the S&P 500 or for the Nasdaq 100 for that matter. That's the price action. Let's get you some morning calls. First up, Barclays lowering its price target on Netflix, warning the earnings reaction may, quote, persist beyond the short term. That stock is down by more than 10%. Your second call from JPMorgan raising its price target on Charles Schwab, expecting Schwab's net interest margin to expand throughout the year. And your third and final call from BNP Paribas, upgrading ExxonMobil to neutral and boosting its price target, expecting oil prices to remain above pre-war levels even after the recent pullback. And that right there, is your third morning call. Let's get to the war. Weighing on global economies, Dileep Singh, the former US Deputy National Security Advisor, writing the war and its effects have reduced global growth estimates for 26 by about 50 basis points, with US growth appearing particularly resilient. Dileep joins us now for more. Dileep, good morning. Good to see you.
Good to see you. Welcome back to Washington.
Lisa was talking about the average. The average has come down a bit. Within that average, where are you seeing the greater hits?
The greater hits will be in Asia and Europe. But look, I mean, I don't know if any of you can tell me with a straight face that the world is safer, more secure, and more prosperous because of this war. I mean, we know that deficits will be larger, inflation will be higher, we'll have less and later monetary easing, interest rates have risen, growth will be slower, supply chain disruptions are certain. Those are just approximate economic effects. Then you look at the strategic ledger. The IRGC, it's still entrenched. more embittered. Still got 1,000 pounds of enriched uranium that can make 10 crude atomic bombs. They have more money, twice as much energy revenues per day than they did before the war. They control the mother of all choke points. America's key adversaries, Russia and China, they're winners. America's alliances, dysfunctional. So look, I'm not here to tell a doomsday story, but
sounds like one.
Equity valuations surpass the pre-war baseline, I'm out.
You think the world's changed permanently?
No. So look, I think big picture, we're caught in a tug of war between two profound and opposing forces. On the one hand, we have a once-in-a-century productivity boom led by general-purpose technologies, not just AI, synthetic biology, fusion, et cetera. But on the other, we've got the forces of fragmentation within and across countries that are pulling the world apart. So we'll have more frequent conflict, we'll have more weaponization of choke points, we'll have more energy insecurity, and we'll have more erosion of institutional norms. Markets are more able to price the right tail than the left tail. But I think sometimes you got to look up from your Bloomberg screen and just open your eyes. The world is not better off because of this war.
What do you think could be a memorandum of understanding between Iran and the United States? Not a serious, comprehensive deal, but what could be a base case that can come out of talks?
I've never heard of an MOU settling a war, but there is deal space, and I understand why there's relief in the markets from the lows. You can imagine a deal in which Iran agrees to ship its 1,000 pounds of enriched uranium to a third-party custody, Russia or China, for example. I can imagine phased sanctions relief in exchange for a phased reopening of the strait. I can imagine some type of pledge by the U.S. to not seek regime change in Iran and perhaps to have China as a guarantor of the deal. So it can come together. I think there's political appetite on both sides. But my point is on valuations. How much is that relief worth?
But if we were to get something like that, a deal like that, is that not better than where we were before this war with Iran?
Well, I'm not talking about a full reopening of the strait. This was not a choke point. It was a latent risk prior to the war. Now it's an active risk. And it's not the only choke point in the world. We've got a lesson that's been learned from this conflict, which is that you can use asymmetric force, very inexpensive asymmetric force, to weaponize an economic choke point and stand down the greatest military in the world. Think about APIs, pharmaceuticals. Think about graphite. Think about lagging edge chips. Think about all the critical minerals in which China has a choke point. Those could all be weaponized. And that's going to be a lingering cost of this war, among all the other factors that I mentioned.
You said several times, I'm out. It's a valuation story, talking about the record high after record high. As vice chair of PJM, are you saying actively sell this market because ultimately it is not accounting for some of these risks?
No, I'm not saying actively sell. But, I mean, we're talking about an equity market that is now effectively judging the world to be a better place to invest than it was before the war. That's all I'm saying. I fully understand the initial conditions prior to this war, very favorable. I still believe that U.S. growth is relatively well insulated. AI, CapEx, and wealthy consumption, it's reflexive. They're much more sensitive to asset prices than oil prices. And, probably have more fiscal stimulus. So I understand why we've recovered. And I've been calling for a recovery since late March. But we're now getting beyond the point in equity markets where I can rationalize these valuations. Markets don't always give you an undistorted lens through which to see the world as it is. And that's what this moment is.
There is a cold, hard truth about markets, which is people will look at what potentially has changed going forward. And it could be things like maybe the diminished use of the dollar. Should there be a greater use of the Chinese renminbi in the Middle East? It could be that there is persistently higher inflation for higher sort of term premia, or just this idea that yields might stay here. What are the fundamental aspects that you think have changed in markets as a result of this conflict? So,
just to be clear, I think dollar primacy is going to remain intact, but the exorbitance of the dollar's privilege will continue to diminish. I think in terms of this war, there's a real historical irony. 1974, that's when Treasury Secretary Simon flew to Jeddah, and he said, how about you denominate your oil sales in dollars, and you recycle those dollars into U.S. Treasuries? The petrodollar system is born, and it reinforced dollar primacy for a generation. Now, some portion of the oil that's still being sold through the strait is being denominated in crypto and, more importantly, renminbi. Is that a psychological inflection point? I can't judge. But does it chip away at exorbitant privilege? Yes. No question.
These are important issues, so let's go through them one by one. The erosion of dollar primacy, one. Two, you alluded to this earlier in the conversation, an increase of the frequency of supply-side shocks potentially in our future beyond this particular crisis. I think this raises big questions about the role of fixed income in a portfolio. What do bonds do for you if that's the world we've got over the next several years?
Well, you're still going to find protection in shorter duration instruments. You're still going to find value in credit that's well secured and high quality. I think when you go out the curve, you've got to start worrying about, some of these second-order effects that I mentioned, the persistence of inflation above target, a world of fiscal dominance. The shocks on the supply side will keep coming. That should raise the risk premium, the term premium, in the long-duration bonds. And I think we're going to start to see the yield curve steepen out as a consequence. Non-dollar assets should continue to outperform real physical assets, particularly those that are important to shore up economic security, where supply chain vulnerabilities persist. Those are all commercial opportunities, and I think that's where the money will go.
What kind of numbers are you thinking about at the long end of the curve? I don't expect to pinpoint a specific number, but a range, a new elevated 10-year yield.
So, the way I think about it is I think our star has probably risen due to the productivity tailwinds that we have, let's say about 1%. I think the new kind of normal, I call it the old normal actually, for inflation is about 2.5 percentage points. And then I think 100 basis points of term premium makes sense. So I get a 450 10-year note as kind of being fair value.
Not too far away from where we are at the moment at 4:30. Dileep, it's good to see you. Lots to think about. The former US Deputy National Security Advisor, Dileep Singh there, thinking more about 450, and 430 is where we're trading at the moment.
Yeah, the idea of volatility and inflation is something that really keeps popping up. And how do you count for some sort of haven asset if you aren't sure what shock you're actually trying to hedge against? And I think that keeps coming up in conversations. The people who are the defenders of the 60-40 and people who are saying, you know what, I think I'm just going to buy a stash of aluminum and a barrel of oil.
Well, when Dileep talks, it's very complicated to understand the position the U.S. government is in right now. The Strait of Hormuz was opened before this conflict. And now it is part of one of their red lines and negotiating tactics, and it's the huge point of leverage this regime has.
Stocks are positive once again, 60 minutes out from the opening bell, up by 0.25%. Coming up on the programme, Nathan Sheets of Citi Research on the path ahead for interest rates. Plus, Danny's back. Danny's got your morning movers. Netflix shares continuing to slide on weak guidance. That stock is down by more than 10%. Live from Washington, D.C., let's check out the price action together, starting with equities on the S&P 500, on the NASDAQ, on the Russell. On the S&P 500, you'll notice we're out to session highs, up by 0.5%. This story dropping from Axios just moments ago. The U.S. and Iran negotiating over a 3-page plan to end the war, with one element under discussion being the U.S. would release $20 billion in frozen Iranian funds in return for Iran giving up its stockpile of enriched uranium. This according to 2 U.S. officials and 2 additional sources briefed on the talks. You'll notice equities are out to session highs, on the Russell up by 0.7%. If you check out the bond market, yields are a little bit lower. The 10-year's down by 2 basis points or so. The 2-year down to 375. In commodities, we're now down by more than 5% on WTI. WTI actually breaking down into the 80s, 89, 86. Brent crude at 94, approaching 95. Just a break in 95 moments ago, down by more than 4% on the session. So, the headline dropping from Axios just moments ago that the U.S. is considering a $20 billion cash for uranium deal with Iran.
So this would be very interesting. This would be really the first step to a more negotiated peace deal when it comes to that enriched uranium. But this would be basically the United States paying for Iran to get rid of it or giving them some relief. So these frozen funds, they have a lot of frozen funds over the years in these accounts, that a lot of this money has been used only for humanitarian aid. This could potentially mean a wind down of the war. But you have to think the Iranian hawks in this administration are not going to be happy with that kind of deal.
It's a very modern cash for clunkers. But look, we're looking forward to some sort of resolution maybe this weekend. And every time that we get some sense that things aren't getting worse, markets rally. And we can see that. There's sort of this drip, drip, drip of better than expected news, and people are welcoming it in markets.
Let's run through it again. So if you're just joining us, welcome to the programme. Equity futures out to session highs, about 60 minutes away from the opening bell. Some reporting from Axios just moments ago suggesting the US and Iran are negotiating over a 3-page plan to end the war, with one element under discussion being that the U.S. would release $20 billion in frozen Iranian funds in return for Iran giving up its stockpile of enriched uranium. That reporting coming from Axios just moments ago, driving equities out to new highs, up by 0.6 on the S&P, on the Russell, up by 0.8. We'll get you more on that story in just a moment. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. It's been a really good week for software. In fact, the S&P software index is up 13.6% so far this week. That puts it on track for its best course of a run since 2001. And today, the gains keep coming. Salesforce, Adobe, ServiceNow, all up at least 2.33%. To be clear, no specific reason, no specific news for why software is rebounding this week, but it's caught in on the general risk-on tone. Maybe it's short covering, maybe it's dipping. Either way, again, a very strong week continues today. Elsewhere, we had some regional banks reporting results. Ally Financial beating across the board, and it was all due to loans for cars. Despite the fact that gasoline prices are higher, there's concerns about how the consumer is feeling. That did not matter. People were taking out loans to buy cars. Those shares up 2.5%. Truist, a little bit weaker. They reported results. Their credit losses were higher than expected. Finally, Netflix, a disappointment for their second quarter outlook. There were high expectations given that they've raised prices. They're working on this ad-supported tier. They're doing more live events. We also learned that Reed Hastings will be stepping down. Those shares down to 9.5%, John.
Danny, thank you. Danny Berger there with your morning movers. Look out for Danny at the top of the hour in about 30 minutes' time to guide you into the opening bow. The opening bow less than 1 hour away. If you are just joining us, moments ago out to new session highs on the equity market. We've been encouraged by the communication coming from the US side for much of the last week that we were getting closer and closer to a deal. This drop from Axios just moments ago that the US and Iran are negotiating over a 3-page plan to end the war, with one element under discussion being that the US would release $20 billion in frozen Iranian funds in return for Iran giving up its stockpile of enriched uranium. Annmarie, a big question here as to whether the Iranians would actually get on board with a deal that sounds like that one.
Well, the issue right now for Iran is that their economy is absolutely battered and they need the money and they are really dire for that cash. So potentially this could be some sort of off-ramp. And also in this Axios report, they're talking about maybe meetings taking place once again this weekend in Islamabad, maybe on Sunday. So when the president says he's not looking to extend the ceasefire, which ends next week, April 22nd, because he thinks a deal will be before then, maybe this is the deal he's talking about.
Tyler Kendall jumping in front of the camera for us to break down some of the details of this reporting and to set the stage for us going into the weekend. Tyler has more. Hey, Tyler.
Hey, John. Well, at this point, this reporting from Axios comes on the heels of President Trump yesterday indicating that progress had been made when it comes to concessions in Iran's nuclear program. As you've already outlined, though, we have not gotten confirmation yet from Iran that any of this progress is happening. And at least publicly, the sides have appeared to be pretty far apart on some of these issues. But Axios reporting that in exchange for Iran giving up its already enriched material, we could see this unfreezing of about $20 billion in Iranian assets. But the reporting goes on to say that both sides have still put forward their separate positions on this, long maintained, including that the U.S. would like to be able to retain this stockpile, while Iran has previously said that they would like to see it diluted. We saw that, for example, in the latest round of talks before the war when the two sides had been meeting in Geneva. It is going to be something to watch for here because, as Annmarie has mentioned, we know that Iran would like to see this money flow through. One of their top demands throughout these negotiations is that there has to be an unfreezing of these assets and there has to be sanctions relief. So something to watch for, but definitely considered to be forward-moving progress after President Trump indicated maybe he won't need to extend that ceasefire deal.
Tyler, have we confirmed there will be another round of talks between the US and Iran over the weekend? Is that a promise?
Well, at this point, President Trump had alluded to that potential, and we heard from the White House earlier this week that they were working on another round, but we still haven't gotten that firm confirmation. The White House Press Secretary Caroline Leavitt did say earlier this week that if the in-person talks were bound to happen, they would be held and hosted again by Pakistan, as the White House has actually thanked Pakistan for being a mediator in this conflict. We know that a lot needs to happen here in order for there to be an agreement, as Bloomberg News previously reported that we could be looking at a potential 2-week extension that essentially would be to allow negotiators at the technical level to work out more of these details before senior officials ultimately meet face-to-face.
Tyler Kendall. Tyler, thank you. Thanks for breaking that down. Check out crude. 95 on Brent, a break of 90 on WTI, 89 on WTI crude, and down by somewhere between 4 to 5% on the session so far. There's going to be a lot of hope going into the opening bell?
Well, there's been a lot of hope already, and people are looking to any kind of resolution. I wonder how asymmetric the risk is, given the build-up to these talks and given how much markets have rallied. Should there be any kind of setback versus the opposite? And we're seeing that kind of engagement with the rally even further this morning.
Nathan Sheets of Citi Research joins us around the table. Nathan, good morning.
Good morning.
How much damage are we doing in the meantime?
Well, I think there is significant pressure on the global economy at the moment. When you think about closure of the Strait of Hormuz, we always thought of that as kind of a third rail for the global economy. And by our estimates, something on the order of 10 million barrels a day of oil is shut in as a result of that. And if that persists, then I think that we could see oil prices well in excess of anything that we've seen so far. And meaningful markdowns to U.S. and global economic growth and appreciable recession risk. I think the key question, and this is where the markets are, is will this persist? And if we get a deal, I don't think the markets are so interested in the exact details of the deal.
Sure.
They just want to see a cessation of these pressures. And my sense is that this is a market that is ready to rip once it gets kind of an all-clear signal from the administration and from the Iranians.
The sense that we get from so many market participants is that this is avoidable because it's so bad it has to be avoided. Steve Orth, the Federated, put it nicely. He wrote the following: our collective experience has taught us that outcomes that are economically and politically untenable tend not to materialize. Is that how you think about this situation?
I think that is a reasonable argument, but in addition and on top of that, I would also say that the signals we're getting from the Trump administration are that they are not looking for this to be an extended conflict. You know, where this is different than the tariffs, however, is with the tariffs, President Trump could calibrate them and turn them up and turn them down, and the effects of the tariffs would follow necessarily. Here, there's another party in play, and that is the Iranians. And we've seen that Iran is not always cooperative or predictable. So there is an extra dimension of risk associated with this relative to the tariffs. But on balance, it seems that the thrust of communication and kind of the narrative over time has gravitated towards some kind of a cessation or a easing of these pressures.
Even if there is some sort of easing in the pressures, how much has the backdrop changed with an increase instance of supply shocks? Talib Singh was just on, and he was painting a pretty negative picture of the world. You guys were, in an argument ahead of that. You were taking the other side of it. But how do you sort of gauge what that looks like through an economic lens?
When I think about this, are there disruptions that are likely to persist? Absolutely. But for how long? And I think that many of these near-term challenges, if we have a deal, maybe they persist for a month or 6 weeks. But by the end of the year, we're going to be talking about other things. And I think the big question from a macro standpoint is this a 6-week disruption, which seems almost certain, even if we have a deal today? Is it a 6-month disruption, or is it a several-year disruption? And I think at this stage, the only thing I'm comfortable saying about a year or longer is that there will be a couple million barrels a day of production that are going to be offline. And I think that before we were thinking that the medium-term oil price would be around $60 a barrel. And I think now we're likely to be looking at something more like $80 a barrel. And that's roughly where the futures markets are. But I think the global economy can grow nicely with $80 a barrel oil.
Do you think that there's a step change in the ramifications for the global economy if the talks this weekend break down? If the ongoing closure of the Strait of Hormuz continues for several more months and isn't resolved in the next couple of weeks?
Clearly, the markets are pricing in some kind of a deal in the not-too-distant future. And if it feels like that falls apart, and what would worry me is if it does fall apart, then does the story on the ground and the intensity of the conflict and the disruptions associated with the conflict potentially escalate, then I think that there could be a sharp nonlinear downside for markets as they price in those new realities. I think that, as you've said, the market's very much leaning towards something being announced likely over at least the next few weeks.
Well, that is a possibility, though, because the president, Pete Hegseth, has spoken about that. If there's no deal, then they can go right back to escalation. What kind of drawdown would we see, say, Monday morning if talks truly break down in Islamabad this weekend, if they happen?
It's difficult to predict just how adversely the markets would react. We have seen during periods when the situation looks more severe, the oil price trade at 110. And so if you had a full break of these negotiations, to see it pop back up to $110 a barrel seems to me a reasonable hypothesis. But to be clear, if we have 8 to 10 million barrels of oil offline for an extended period, fill in the blank as to how high oil prices could go. That could be a world with $150, $200 a barrel oil. And in some models, I can even get numbers that are much higher than that.
Nathan, it's good to see you. Nathan Sheets there, Citi. Thanks for reacting to that breaking news just moments ago. Certainly the bar got higher for talks going into the weekend. Let's get you an update on that story, that breaking news, with your Bloomberg brief. Scarlett Fu has more. Hey, Scarlett.
Hi, John. Yeah, this hour we learned that the U.S. and Iran are negotiating a peace plan with one point under discussion, the U.S. releasing $20 billion in frozen Iranian funds in return for Iran giving up its enriched uranium stockpile. This is according to Axios. The talks are expected to take place in Islamabad on Sunday. Meantime, Netflix shares are lower in the pre-market after the streamer's second quarter forecast missed analyst estimates. Netflix also announced that its co-founder and chairman, Reed Hastings, will step down from the board after 29 years. And SpaceX is moving up its vesting schedule for employees. Sources telling us here at Bloomberg it could come as early as next week as the company prepares for its IPO, which, as you'll recall, is targeting a valuation of more than $2 trillion. And that is our Bloomberg brief. John.
Scarlett, thank you. Thank you for this morning. One of the best there, Scarlett Fu. Up next on the programme, setting you up for the day ahead. Plus, we'll catch up with Jason Thomas of Carlyle, with stocks looking for their third consecutive week of 3% plus gains. That conversation up next.
The technicals in the equity market are extraordinary. And the earnings numbers that are coming through are pretty powerful. You're going to have an IPO calendar this year that maybe is a couple $100 billion, maybe. We're going to buy back $1 trillion of stock this year. So we're actually, there's not enough stock to buy. I mean, it's amazing in the equity market how good the technicals are.
Rick Rieder of BlackRock there on the equity market, all-time highs on the S&P 500. And moments ago, another reason for an increase in stocks this morning. Equity futures pushing higher on the S&P 500, on the Nasdaq, on the Russell up by 1%. For the commodity market, crude, Brent, WTI down by around 6 to 7% at the moment. Bond yields down across the curve, the 10-year yield down by 6 basis points. Some encouraging signs, not just from the US side and the reporting from Axios, but also from the Iranian side.
Just moments ago, the Iranian foreign minister said in line with the ceasefire in Lebanon, the passage for all commercial vessels through the Strait of Hormuz is declared completely open for the remaining period of the ceasefire. The ceasefire ends next week. Now, does he mean vessels that are friendly enough to Iran, say maybe Turkey, Pakistan, Russia, China, or all commercial vessels? But for this market, that is definitely a step in the right direction when it comes to potentially seeing the reopening of the Strait of Hormuz.
Lisa, that headline paired with this story, the US and Iran negotiating over a 3-page plan to end the war, with one element under discussion being the US would release $20 billion in frozen Iranian funds in return for Iran giving up its stockpile of enriched uranium. That report, those words coming directly from Axios earlier this hour.
So we're setting up a really interesting situation heading into the weekend of talks potentially on Sunday between the U.S. and Iran. It seems like this market has been ripping higher on the expectation that you would get a prolonged ceasefire. How much people who wanted to sit on their hands heading into the weekend because they didn't want to get caught off guard for a Sunday night are being forced into the market now because of these reports. It just sort of highlights how everyone's just waiting until the all clear has been announced to get back to seeing the positives in the earnings report.
We're certainly adding to gains right now in the equity market, that's for sure. On reports, the US and Iran will be holding talks in Islamabad on Sunday, and maybe some of that energy will start flowing through the Strait of Hormuz in a much bigger way. Jason Thomas of Carlyle writing, markets are increasingly being shaped by national security priorities. For investors, that means being selective and leaning into areas with real demand, pricing power and structural tailwinds. Jason joins us now for more. Jason, good morning. Good to see you.
Morning.
What a crazy 6-7 weeks this has been in markets. How are you reflecting on things?
Well, I think that you have three elements as to why we've seen this rally. First, of course, is just this stated willingness to reach a negotiated settlement. So keep getting good news on that front, I would say. Secondly, the resilience of the economy. Our portfolio data through 31 days of the conflict, so March 31st, showed real demand growth in the United States of 2.7%. Obviously, good implications for earnings. So I think people have taken comfort in that. And third, I think the underappreciated element here has been the way that markets were, I think, wrong-footed or misapprehended what was happening in short-term interest rates. You had that period of time where people interpreted the price shock that was coming as essentially forcing the Fed's hand to raise rates. That was never the intention. It was never likely. What happened during that period of time was essentially an unwind in some of the aggressive bets on a Fed that would be cutting early and often. At the start of the year, if you looked at options on futures, 7 rate cuts were priced as equally likely as 1 rate hike. As some of those trades got flushed out, some of the steepener trades got flushed out, you had a jump in the 2-year yield, you had a jump in those forward interest rates. Those trades, that unwind really came to a conclusion about March 30th. No surprise, that is actually the date of the nadir in the recent market.
Well, and so this is one tailwind to the recent rally, is that you've seen short-end interest rates come down as people reassess that. I just wonder longer term, though, is there a sense that people are underappreciating still the level of inflation that's going to be in the system for a long period of time as we face off with supply shocks that are more likely going forward?
Well, the Fed has been willing to tolerate 3% inflation for quite a long time. What's another 100 basis points among friends? So, So when you think about inflation, where it's likely going, you have I would expect a 100 basis point shock in Q2 that's going through the system. But I think the expectation is that it's not continued inflation, it's that prices will peak and then either stay where they are or come down somewhat. And that actually means that sequential inflation would fall. So again, it's important to differentiate between the price level, which will, I think, remain high for many key inputs. And we talk about energy, but this is, of course, much broader. When you think about the nitrogen-based fertilizers that go through the strait, when you think about sulfur, obviously sulfuric acid necessary for metal processing and refinement. When you think about helium, for which there's no substitute for extreme low-temperature cooling for semiconductor manufacturing. All of these inputs, prices there's going to be shortages in the near term. All these prices are going to be high. But again, after June, you have to suspect that the prices will no longer continue to escalate. And so if you have sequential inflation that actually falls, the Fed could be in a position to cut by September. And I think that, so again, it's distinguishing between the price level effects of this conflict, the closure of the strait, and again, what we should expect on an ongoing basis.
Maybe heading into this, people were asymmetrically pessimistic about the potential for rate hikes and the potential for some sort of global economic shock. Are people overly optimistic, though, heading into a weekend where there's still a lot of vagaries to potentially be worked through?
Yeah, I think that, again, it may just be that people, you look at the software space. I mean, that could be a lot of short covering, of course, but that was a case where I think people were far too pessimistic about the viability of an entire industry. It was really the way that this Armageddon scenario. And you have now, obviously, this rebound of 13%. And I think that in some ways that's the broader market, just overestimating the downside, at least the likelihood of it. But there is still tail risk here. There is a range of outcomes that we should all appreciate that extend into very, very bad territory. And I think that we also have not yet seen how people digest what I do think will be some bad data in Q2, just as some of these effects run their way through the system. And so how are markets going to react to that? Are they just going to be able to look through it, or are they going to have second thoughts?
Let's work through the price action right now. We've got Jason Thomas of Carlyle alongside us. Equities out to session highs on the S&P. Crude is down by 9% now on Brent. WTI trading in the mid-80s, down by close to 10% on the session. We had a report from Axios that we broke around 8:30 Eastern time, suggesting the US and Iran was considering a cash for uranium deal and that talks were likely to take place this coming Sunday. Shortly after that report dropped, we heard from the Iranian foreign minister saying the following: in line with the ceasefire in Lebanon, the passage for all commercial vessels through the Strait of Hormuz is declared completely open for the remaining period of the ceasefire on the coordinated route as already announced by Ports and Maritime Organization of the Islamic Republic of Iran. That last line, I think, is really important to try and get some additional clarity on what they mean by that.
Absolutely. Devil's in the details here. What kind of vessels are we talking about? Are these Iranian vessels? Are these vessels that are paying a toll, that are close to the regime? Or is this for all commercial vessels to go in and out of the Strait of Hormuz? But it is a step in the right direction, and will certainly be a test for this White House on what they want to do with this information going into negotiations on Sunday.
Quite a series of headlines over the last hour or so, driving this equity market out to new highs, closing at record highs yesterday and added some weight to the rally so far this morning. Jason, good to see you, sir.
Thanks
for being here. Thank you. Coming up on Monday, reaction to the talks if they take place over the weekend. We'll speak to Cameron Dawson of New Edge Wealth, Claudia Salm of New Century Advisors. Plus, we'll speak to Mark Lehman of Citizens and Stephen Parker of JPMorgan. From Washington, D.C., thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.